Good morning. I'm Julie Hyman alongside Brian Sozzi this morning. This is Yahoo Finance Live. Let's get right to the three things you need to know to start off your morning. First thing you need to know. Financial regulators swept in this weekend to stabilize the banking system following the collapse and seizure of Silicon Valley Bank. The Federal Reserve, Treasury Department, and FDIC said all customers will have access to their money held at the bank starting today. The same goes for depositors of Signature Bank, which regulators shut down over the weekend as well. They also announced other measures to prevent bank runs at other institutions. The situation has a lot of Wall Street thinking how much the Fed will raise interest rates at its meeting next week. Goldman Sachs already changed its view, saying the Fed will not hike rates in March. Morgan Stanley, however, saying that it still sees a path to a 50 basis point increase. Second thing you need to know, the chaos at SVB is reverberating across the banking industry. Bank stocks are declining, with regional banks working overtime to assure their customers that their money is safe. First Republic Bank is leading the drop this morning, with bigger names like Charles Schwab and Bank of America also taking a hit. On the fall, the Federal Reserve unveiled a new program that will better allow banks to manage their liquidity. And third thing you need to know, SVB was the main banker to Silicon Valley, venture capitalists, and startups. And we've heard from companies including Roku, Etsy, Roblox, and Rocket Labs telling us they had exposure to the bank. They should be getting their money today. But at a time when the tech industry is already on edge from massive layoffs and less capital, does this put a deep freeze on the startup industry moving forward? We've got you covered on the latest all morning long, and we go now live to President Joe Biden, who is making comments on this whole situation.
The government regulator in charge, the FDIC, took control of Silicon Valley Bank's assets. And over the weekend, it took control of Signature Bank's assets. Treasury Secretary Yellen and a team of banking regulators have taken action, immediate action. And here are the highlights. First, all customers who had deposits in these banks can rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers. Let me repeat that. No losses will be borne by the taxpayers. Instead, the money will come from the fees that banks pay into the deposit insurance fund. Because of the actions that our regulators have already taken, every American should feel confident that their deposits will be there if and when they need them. Second, the management of these banks will be fired. If the bank is taken over by FDIC, the people running the bank should not work there anymore. Third, investors in the banks will not be protected. They knowingly took a risk, and when the risk didn't pay off, investors lose their money. That's how capitalism works. And fourth, there are important questions of how these banks got into the circumstance in the first place. We must get the full accounting of what happened and why those responsible can be held accountable. In my administration, no one is above the law. And finally, we must reduce the risk of this happening again. During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses. Look, the bottom line is this. Americans can rest assured that our banking system is safe. Your deposits are safe. Let me also assure you we will not stop at this. We'll do whatever is needed. On top of all this, let's also take a look at a moment to put the situation in a broader context. We've made strong economic progress in the past 2 years. We've created more than 12 million new jobs, more jobs in 2 years than any president has ever created in a single 4-year term. Unemployment is below 4% for 14 straight months. Take-home pay for workers is going up, especially for lower and middle-income workers. And we've seen record numbers of people apply to start new businesses, more than 10 million of them, more than 10 million applications over the last 2 years starting businesses. Now we need to keep this progress going. That's what swift action that my administration over the past few years is all about. Protecting depositors, protecting the banking system, protecting the economic gains we've made together for the American people. Thank you, God bless you, and may God protect our troops. See you in California.
Mr. President, what do you know right now about why this happened? And can you assure Americans that there won't be a ripple effect?
That was President Joe Biden speaking about the collapse of Silicon Valley Bank and also the seizure of Signature Bank. The president emphasizing here that there will be no taxpayer burden as a result of federal regulators coming in and making depositors of those two banks whole. He said that they're now still trying to get to the bottom of what happened, that the people who are responsible have been removed, and indeed the management of Silicon Valley Bank in particular is no longer in charge there. And he talked about trying to figure out how to reduce the chances of this happening again. All of this, as we've talked about, after the federal government stepped in on Sunday to protect Silicon Valley Bank deposit holders, as the fallout has ripple effects across the banking system in the U.S. and indeed the world. Let's get right to Yahoo Finance's Jennifer Schomburger now with the very latest. We obviously just heard from the president, and I know you were listening into various calls as well happening over the weekend, explaining the unfolding situation.
Good morning, Julie. That's right. We just heard from President Biden assuring the American public that their money is safe. Depositors at SVB will be made whole, and none of these losses will be borne by taxpayers. Investors will take the fall on this. Officers of the bank will be fired, have been fired, and that Americans should be confident that their deposits in their banks are safe. Now, the president saying that we need to get the full accounting of this, and no one in his administration is above the law. He called on Congress and regulators to enact new rules to ensure this doesn't happen again. Now, these comments coming after the president's direction and recommendations from the Federal Reserve and the FDIC last night, spurring Treasury Secretary Janet Yellen to take emergency action to make depositors of Silicon Valley Bank whole and create a new lending facility to backstop deposit withdrawals across our banking system. As I noted, depositors of SVB will have access to all of their money starting today. Depositors are going to be made whole using the FDIC's Deposit Insurance Fund. Again, regulators stressing no taxpayers will bear losses for this. Now, the Fed will offer funding to banks through a new facility dubbed the Bank Term Funding Program. This will help ensure banks can meet all depositor withdrawals. This is both insured and uninsured across the banking system. This action being taken to thwart any contagion risk. On Sunday, regulators also took control of a second bank, Signature Bank, which was reeling from a bet on crypto banking and a crisis of confidence following SVB's failure. Signature Bank marking the second massive bank failure in 3 days. Now, the Fed's lending facility is designed by the central bank to cover all insured deposits in the U.S. banking system and will be backed by a $25 billion exchange stabilization fund at Treasury, which officials say they do not expect to tap. Fed officials stressed the Fed is not purchasing securities at banks, only lending against their book value, and that no bank is being bailed out. Regulators underscoring they're just trying to help depositors of institutions and that the bank's equity and bond holders will be wiped out. Julie, both the Fed and the Treasury and President Biden, you just heard, saying they are prepared to take further steps as needed to shore up the banking system. Back to you.
Jen, there was a lot of chatter that there would be an auction for these assets. What happened to that, and why wasn't that taken?
Yeah, hey there, Brian. So the government did seek bids for Silicon Valley Bank, but decided to scrap that auction, just given the time constraints and the fluidity and the emergency of the crisis. They wanted to make sure that depositors knew that they were going to get their money back before markets opened on Monday morning to try to thwart any contagion risk. It's possible they could revisit that in the future, but at this point, they wanted to stop any leakage from happening. And that's why you're seeing them backstop both insured and uninsured deposits at this point. Pretty unprecedented.
Jennifer Schomburger, thanks so much. Appreciate it. Silicon Valley Bank's collapse is the second largest bank failure in the U.S. and arguably the first true black swan event for the market since the meme stock craze. But how did we get here? And let's get you up to speed. Julie, there's a lot to unpack here. And I'm just tracking a good newsletter, the Daily Upside, and they're noting, coming out of the company's most recent earnings report, that was Silicon Valley Bank, they had mark-to-market losses of nearly $16 billion and only tangible common equity of $11.5 billion.
Okay,
just a major red flag.
I'm going to push the buzzer on you right now.
Go.
You said mark-to-market and tangible book value loss. Okay, let's explain to people what the heck all of this stuff means, because especially folks who were not around during the financial crisis or people who forgot what all of this stuff means, it really does. You have to have a little bit of decoding here, right? And a little bit of disentangling. So this bank started back in the 1980s, and it really was targeted at serving Silicon Valley and serving startups and the tech industry with the acknowledgement that these kinds of companies don't make money until later in the game, right? Over the last decade or so, or even a shorter time horizon, there were just deposits pouring into the bank because we really saw even more of a boom than ever in Silicon Valley, right? You see here what was happening with deposits, followed by a big reversal in those deposits, because we all know what's been going on with the tech industry more recently. And then these depositors got a whiff that there might be some issues at the bank, so they pulled their money en masse. That outflow in deposits happened last week alone, which is just incredible. But the other problem was not just the type of clientele, but the type of assets that this bank was holding on its balance sheet. And that's where we get to the mark-to-market stuff, right?
Just complicated stuff. 95% of deposits were above the FDIC's $250,000 insurance limit.
Right.
It's massive.
It was massive. And again, that's on the depositor side. On the asset side, what they were holding is actually not complicated stuff.
Yep.
It's about as vanilla as you can get. They were buying treasuries, right? They were also buying mortgage-backed securities, which is not quite as vanilla, but they were buying treasuries at a time when we were seeing higher prices and lower yields in treasuries. Then the Federal Reserve started raising rates. That means it put pressure on their depositors, aka their clients, and put pressure on those treasury investments. So when I'm a client and I come to you at Silicon Valley Bank and I say, I want to get my money out, and Silicon Valley Bank looks around and says, I don't have that cash. I have to sell these treasuries. I'm now selling them at a loss, marking them to market, marking them to present value, and marking down their value. So that's where it all came to a head.
At the root cause, higher interest rates.
Higher interest rates on both the client side putting pressure and on the bank itself, its asset, its balance sheet, putting pressure on.
Yep.
All right, let's figure out, that's how we got here. Now let's talk about more where here is. Jared Blickery is at the Wi-Fi Interactive, and we have just seen incredible movements in the market.
We're seeing some more today. And by the way, excellent explanation there, Julie and Brian. And it really gets to not only the movements that we've seen, it's not the absolute level of these bond prices, it is the volatility, and that volatility spills into everything else. Here we have the 13-week T-bill yield. This is down an astonishing 38 basis points. And let me get to a chart here. This is over the last 3 months. Only a few days ago, we were right back up here pricing in 50 basis points, maybe a hike next week for the Federal Reserve. Now we are pricing in potentially no hike whatsoever. That's how quickly things can change overnight. By the way, this little red dot right down here, this is today, this is yesterday, and that's how much this has moved. We haven't seen moves like this, especially in the 10-year, since right after the Lehman Brothers collapse in 2008. That would be September of that year. Only 3 days ago, Thursday close or Wednesday close, we were sitting at about 4.0% in the 10-year. Now we are down 3.45%. That is down over half a percentage point. Again, we don't see these moves very often, and I want to stress the volatility and what that does to the risk markets here. Here's the ICE B of A move index. That has been creeping up here, and now it looks like it's set to explode to the upside. Here is a 5-year chart. Here is a pandemic high that we saw when we suddenly closed off the world economy overnight. Well, we're heading back up to these levels. All of this tells me that there's a lot of skittishness in the market, and when we see all this volatility, it reduces the available credit, it reduces the available investment for everything else. That includes stocks, bonds, crypto, everything. Here's the US dollar index. Here's one sigh of relief. Perhaps we're not seeing a rush into the dollar. The dollar is a safe haven asset, but we are seeing a move into the yen. Here we're seeing the euro versus the Japanese yen, investors going into the more safe haven asset of the yen. That's what happens historically during these movements. Now, I want to show you what's happening to the regional banks. This is over over the last 2 days. Some of these moves absolutely astonishing to see on a 2-day basis. A lot of these plays, relatively stable stocks here. They don't move that much per day, and yet we're seeing moves of 50%, and that's not even including what's happening overnight. Some of these stocks now, WAL, FRC down another 60-70% overnight, guys.
Yeah, I'm looking at First Republic here too, Jared, down 63% here in the pre-market. Some very, very wild moves. Now, the chaos at SVB is having ripple effects across the banking industry, echoing the financial crisis of 2008. So what happens from here? Let's bring in Hennessy Large Cap Financial Fund Portfolio Manager David Ellison and S&P Global Market Intelligence's Nathan Stovall. Good to see you here both this morning. Dave, let me start with you. You have skin in the game in your fund. You had Signature Bank in there. Your thoughts on what the government has done here and what moves you're making this morning?
Well, it's, as a portfolio manager, I'm surprised I have time to be on TV. I should be taking care of my shareholders. But I think that, the issue is that, I think Julie laid it out pretty good in talking about the mark-to-market issues. Again, the 2007, 8, 9, 10 was a credit mark-to-market. This is an interest rate mark-to-market, a lot different. It seems to be equally as punishing. But I think, you have to accept the fact that you missed it and you're going to take a hit in the portfolio. And I think I've got a bunch of other names that look very safe, like JP Morgan and Wells Fargo, and they've gotten hit too. So, it's been a tough realization that risk and fear are still very much alive in this marketplace. And I think the electronic nature of the banking system now, people can move money very rapidly. This isn't people lined up outside with their passbooks looking to get $20 out. This is people that are calling, going on the internet and pulling, millions of dollars out very, very quickly. So, this liquidity issue is, I think, bigger than the Fed ever expected. And I think it's going to be a struggle going forward here to kind of reestablish a sense of liquidity in the system.
Yeah, it definitely feels that way. And Nathan, as is always the case when these kinds of things happen, there are some people who look at it and say, well, we should have seen this coming if you really scrutinized the balance sheet of this particular bank, which leaves me to ask, where else are we going to see these kinds of vulnerabilities? Even with this backstop that now we have seen put in place, is there a chance that we could see other financial institutions fail?
Well, hopefully not. And I think David and you both put it pretty well on what drove this issue. But one of the points I want to add to that is that, this is really sort of a crisis of confidence in those institutions. And that while there was a liquidity mismatch, asset liability mismatch, you also had the two banks in question here heavily concentrated in large deposits. As you mentioned early on, the amount of uninsured deposits at SVB was way higher than what you see across the industry. It's not to say that large deposits are bad, but it allowed for the speed of withdrawals to be much higher. The other thing I would mention is that they were so heavily focused on the VC industry, which many of us have talked about over the last few days. But that allowed really for, I think, groupthink to come out as people got concerned. Similar with Signature, a little bit different story, but the fact that they had crypto exposure and what we had seen with Silvergate winding down operations last week, I think really accelerated things there. But that's the one that is perhaps more surprising to anybody. And I think one of the reasons why you've seen regulators respond the way they have, with backstopping uninsured deposits at both those institutions, as well as coming with their term lending facility. And they're hoping it's a bazooka and really assures depositors that their money is safe in these institutions by providing additional funding.
David, you mentioned JP Morgan. Others that I've talked to this morning also looking at JP Morgan, calling out its fortress balance sheet. Of course, that is a term that CEO Jamie Dimon is always highlighting on his various earnings calls. What do you do with a stock like that, and how do you see JP Morgan exposed to the situation?
Well, I think the exposure, I think for companies like that, and there's probably 4 or 5 of them like that, I think is the issue is what is the cost of funds going to be going forward, as everybody realizes that, 10 basis points in a money market fund is not that good. And what is the loan growth going to look like, and what is credit going to look like? I think up until this point, the Fed has been trying to tighten, they've been quantitatively tightening, they've been raising rates, and the banks have been lending. So they've been working against what the Fed has been trying to do. That has all changed dramatically. Now the banks are in a major quantitative tightening mode, driven by liquidity. The Fed is obviously in a quantitative tightening mode. They may change that, they may not. And obviously the rate structure is what it's going to be. But the banks are, I think every bank in America has stopped lending, because that's the best way you can raise liquidity, is to stop lending. And so if there's going to be a recession, it's going to start soon, because the banks have all stopped lending.
Sort of a bigger question I have as well, and Nathan, I'll toss this one to you, is it now seems like there is that implicitly all U.S. deposits are insured, right? Even those above $250,000, because of what has happened in this case. Does that mean de facto that every institution in the United States could theoretically be a systemically important financial institution? Like, is everything now backstopped forever and ever amen? Like, has this changed without sort of a legislative change the way that the financial system works?
I don't think the regulators want that. I think what they tried to do here was calm the fear and provide a window for the rest of the institutions who haven't had as much stress, if they experience outflows, to maintain their liquidity position. So I think it's kind of early days. I think it's extremely fluid. When we look at the two institutions that were closed down over the last few days, where that's going to play out is still up in the air, because they're both in bridge banks. So I think that they're going to do whatever they need to do to shore up confidence in the banking system. But I also think that they are aware of the potential moral hazard there and would look at each situation individually.
Gentlemen, thank you so much for your perspective this morning. I'm sure it was a long weekend. And as you said, David, you guys got to get back to work. David Ellison, Hennessy Large Cap Financial Fund Portfolio Manager, and Nathan Stovall from S&P Global Market Intelligence. Thanks to you both. Appreciate it. We're going to be diving deep into every angle of the collapse of Silicon Valley Bank over the next 2 hours. Jens Nordvig will join us for a discussion on the state of the financial system. We'll also talk about the wider implications for tech and M&A with Solomon Partners CEO Mark Cooper. And we'll kick off our deeper coverage with primetime partners Alan Patricof in just a few minutes. For everything you need to know about the Silicon Valley Bank collapse, check out our morning brief newsletter over at yahoofinance.com. It's written by Brian Sozzi. And Saz, you highlight in the newsletter some things Wall Street is saying about the collapse. They're saying a lot.
There's just so much going on, Julie.
There's so much going on. Can I just say for a second, too? We're all doing this over the weekend.
Yes.
The time changed. Which is like the worst possible timing.
My
for
bagel
the time to
came
change.
out burnt on Sunday morning, Julie. It just stinks. But in terms of the morning brief newsletter, look, I'm really locked in on what Wall Street is saying right now and what Wall Street is not saying. A lot of folks, I look at what JP Morgan's main credit analyst said yesterday afternoon, Caprahan, saying this is not a structural or systemic issue. So, as someone who covered the financial crisis of 2008 and 2009, I still don't get the vibe that this is that type of situation by any stretch of the imagination. That was just a scary time. Not that this is not scary, it just feels and looks very different. And then you have out here this morning, you have a Citigroup coming out here trying to pick the bottom on Charles Schwab, upgrading them. Schwab came out this morning saying things have started off pretty well in terms of trading activity in March. We are well capitalized. Things are looking good there as well. And then you have First Republic. You have JP Morgan coming out here actually recommending to buy this stock that is absolutely crashing here in the pre-market, down 63%.
And then there is the bigger question of rising interest rates, which, as we talked about earlier, was a big contributor to this whole mess. Will they keep rising? Goldman Sachs this morning, Jan Hatzius and the team over there saying, no, the Fed is not going to raise at the meeting next week. We'll raise after that. Morgan Stanley is saying, yes, they will probably raise, and they even see a path still to 50 basis points. Citi also saying that the Federal Reserve is still likely to raise rates. So obviously some big implications.
Lots going on. All right, let's stay, of course, on this. The venture capitalist community continues to reel in the wake of SVB's collapse. So what's next for these upstarts? We're joined by a pioneer in the VC space, Primetime Partners chairperson and co-founder, as well as Greycroft co-founder and chairman emeritus, Alan Patricof. Alan, great to have you on here this morning. Just have to get your thoughts on the past couple days we have seen in the venture capitalist community.
Well, it's certainly been a roller coaster. It's provided, I would euphemistically, jokingly say, entertainment for a not very relaxing weekend. I mean, this is this, in a way, has been a long, long time coming. I mean, it's been brought on by exogenous factors that have nothing to do with the basic fundamental of venture lending, which is really what SVB and Signature and many other banks around the country, particularly in the West Coast, have been doing, which is lending to venture-backed early-stage startups, which are, by their nature, startups in high risk, with many of them without significant revenues, and providing lines against those to those companies, which were, in my opinion, totally justified or totally explained. That's a better word, by their assumption that the venture capitalists who backed the equity of these companies, to whom the banks were extending lines, would come in and supply equity capital almost before the bank lines would be drawn down, or simultaneously with, and that in the meantime, they were getting huge deposits from the financings these venture capital backed companies had done. And it was really a kind of lending that in 40, 50 years ago, before SVB, would have been called senior preferred type financing. And SVB came in and invented a whole new concept of what they call venture lending, which was to make loans out of things that would have normally been senior equity. So, but that in the end isn't what tipped them. I gather it was because they went long on their maturities and they couldn't deal with their short-term demands of these lines being drawn down, and it created a very dramatic, quick mismatch. And of course, they have the deposits of every one of these companies, and as it has been stated, and is absolutely true, there are thousands of companies who have deposits with these banks, which are perfectly legitimate deposits, and the banks' the deposit assets were perfectly fine, but all of a sudden they're put in jeopardy because of the bank's own problems.
Right. And Alan, just to be clear here, you guys are based in New York, I believe, but obviously you're in the startup business as well. Did you or any of your portfolio companies have money at SVB, and what now sort of happens to the wider community as a result of this bank going out of business?
Well, you were asking me a question, which I've been in the venture business 52 years, and to say I don't have any investments that are affected by this would be ridiculous. Right. We have, going back, 40 years ago to when the SVB started, many of our companies took advantage of lines and from these banks, and gleefully called down on those loans. And many, we have a portfolio, fortunately, is not in prime time, is I'd say almost all our companies have not drawn down on their line. So they're sitting there with deposits in these banks, for those who used any of these banks, and that was limited, and limited size of deposits and limited size of exposure. They are now in a position like every other venture-backed company that is expected to draw down on lines as part of their financing plan, are now going to have to, and that's the key thing here now. I mean, they are going to have to look for alternative sources of capital, because my assumption is that this type of lending is going to change dramatically, and that banks are going to be very, very cautious about lending to early-stage startup companies under the assumption that they're traditional, in quotes, loans, if you will. And I think that it's going to open up the need for convertible debt financing from other types of lenders or investors, I should say, or the preferred stocks. But it's going to take more of an equity characteristic to it, and not require loan servicing and repayment. which traditionally venture loans that were made by SVB, Signature, and all the others, by their character, required at some point. So I think that's going to open up opportunities for new types of investors, and at the same time, I am sure that the terms are going to become much more severe and more appropriate to the risks that are being taken. They'll have a senior characteristic to it, but it'll be a senior equity rather than disguised as venture debt, unless there are firms that have venture debt that have assets and have revenues and maybe profits, and where the SVBs and Signatures were going to make a lot of their money was not just from the loans and the interest rates, but from the enormous amount of warrants that they got in each of these companies. So when they made extended a line, they were getting warrants and they were also getting deposits. So, as long as the system kept working, it made sense, and that's why the banks were prospering in the market. Now it's all come home to roost, and for reasons that had really nothing to do with the fundamentals of the businesses. They didn't overnight change what they were doing. It was really the bank's problems.
Alan, how concerned are you that what the Federal Reserve is doing in terms of raising interest rates and going back to see how far they have raised interest rates already this cycle, how concerned are you that their efforts will make this situation worse?
I don't have any insight, nor does anyone else on this show. I would guess that they would not raise this, and at this particular moment in time, I'd let things rest for a while. I let the banking system find a level that is comfortable, and excuse me, that the market's opening. It just evidently opened 2 minutes ago. I'm not watching the tape in any way. We're going to see, how the system adjusts to itself. I think a lot of people, I'm certain a lot of companies are now going to test the ability to, get their deposits to the extent that they need them, just to make sure that they really can access them. And secondly, people are going to test to see the lines they have really are there, maybe even if they don't need it. So there's going to be put pressure, and I think the Federal Reserve has said they're going to make liquidity available so that a lot of companies, let's say a young company is at a very early stage, losing several $100,000 a month, has a few $1 million in cash in the bank. My guess is they'll access their line, wherever the bank line is, and draw down some $500,000, $1 million. I would doubt whether they go draw their whole line down and see if really the wire transfer comes through. And, I think over the next several days, that will probably give confidence that these lines are going to be met where they have been extended. I mean, the Federal Reserve is not going to assume the lines that are outstanding for SVB or Signature or anyone else. I mean, they're going to protect the deposits, which is the right place. Mm-hmm. But if you had a line at any bank today, you're going to have to secure today to find out whether the line is really still good. Yep. And alternatively, if you don't, to seek some alternative type of financing, which may not be, I would doubt whether it will necessarily be what we've called venture debt in the past.
Yep. All right, we'll leave it there for right now. Primetime Partners chairperson and co-founder, as well as Graycroft co-founder and chairman emeritus, Alan Patricof. You're always gracious with your time for us. We appreciate it. Thank you.
Thank you.
All right, we just had that opening bell on Wall Street and what could be a volatile week. This market's coverage sponsored by Tasty Trade. Julie, wow, not that bad of an open so far, but of course we're seeing a lot of wild moves, notably in the regional bank space.
I mean, it's not a great open.
Not a great open, but all things being considered.
If you look at the three major averages, we are indeed seeing declines here for them. And all three of them, last I checked, were down by about 1% as we got out of the gate here this morning. If we look on the intraday basis, although the Dow is doing the least bad of the three, interestingly enough. I was just looking at the trending tickers because I really want to dive right into where we are seeing the most movement here, and that is in First Republic Bank. First Republic down 75% over the past 3 days. This morning alone, we saw it plunge by 65%. It got halted for volatility. That's something that was happening periodically during the session on Friday as well. This is one of the other banks that is perceived as having the same types of exposure. And so it's interesting to see it continue to drop to this extent, even with the measures that were taken over the weekend. Still seeing that stock decline is alarming, right? Charles Schwab shares down 18%, even though, Saz, I believe you were saying there was an upgrade for Charles Schwab over at Citi.
Yes.
Nonetheless, still a lot of selling going on in Citi. And if you look at the 3-day chart there, you're seeing a 37% decline. Signature Bank's on this trending ticker list, although obviously it's not trading this morning because federal regulators shut that bank down. It is a crypto-oriented bank, whereas we think of SVB as being more Silicon Valley. Signature Bank based in New York and did cater to a lot of crypto clients. So that stock was down 32% over 3 days before being halted because the government took it over. Roku as well is one of the companies that has disclosed exposure to Silicon Valley Bank, probably the largest publicly traded company that has talked about the largest exposure. Again, it is getting that money back under this government plan, but the stock is still continuing to gap lower this morning. It's down about 8%. And let's take a look as well, a bigger look at some of the groups within the S&P 500. I want to take a look at sectors real quick here. The financials down the most by a long shot here. Right now, down 4.4%. If we look at the 3-day chart here of the financials, down by about 10%. We've got energy, we've got materials down as well. Consumer staples is the only group that's in the green. So it looks like people looking for some safety here. Also, if we look at the banks more specifically, what we're seeing, look at that. Saz, JP Morgan is in the green. That's what we saw
Beacon of safety
last week. That's what it's seen as, which is really fascinating here because you're not seeing Bank of America higher. Like, what is it about JP Morgan? Maybe we can delve into that with some of our guests as well. And then regional banks as well are seeing big declines here. I'm going to call up the meme stocks and let you talk about the memes a little bit here this morning as well, Saz.
Yeah, meme stocks, Julie, in the pre-market, they actually caught bids higher. Bed Bath & Beyond at one point was up 7%. GameStop was higher. AMC was higher. Now we're seeing all of those losses. All those gains reverse here. Now all three of those meme stocks, which were strange because they shouldn't be viewed as a beacon of safety in this environment. These are some of the worst run companies, worst fundamentals in the business, and yet investors were at least piling into those names in the pre-market. And I should note they are relatively
still up, actually.
Yeah, they're relatively outperforming in this morning.
Oh, now it's down 3.5%. I don't know that they were seen as safety. It was more a matter of the initial sort of knee-jerk risk on, because we did see the futures higher very early on in the session after we had the government announce this news, and then those gains kind of melted away as time went on. Let's also, why don't we get a check on crypto as well, because we were just talking about Signature, right? This is the 2-day. I'm going to take a look at the 1-day here for underlying cryptos. Actually, Bitcoin is up. Fascinating. Ethereum is trading up as well, which is not necessarily what you would expect. And if you look at the crypto stocks, quite a few of them trading higher as well. Go figure.
Lots to watch indeed. All right, coming up, we'll head to Washington, D.C., where Yahoo Finance contributor Kevin Cirilli is standing by with the latest political rumblings as the collapse of SVB and Signature Bank ripple through markets. We'll be right back. President Biden spoke this morning, assuring both customers and taxpayers alike in the wake of the SVB and Signature Bank collapses. Yahoo Finance contributor Kevin Cirilli joins us now for the latest from Capitol Hill. Kevin.
Well, lawmakers are waking up to the reality that banking regulation is going to be front and center this week as lawmakers return from their recess. Now, it all started yesterday with the joint regulatory statement that came out from Treasury, the Federal Reserve, and FDIC saying, quote, depositors will have access to all of their money. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. The U.S. banking system remains resilient and on a solid foundation, in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. President Biden, speaking earlier this morning at the White House, had this to say.
All customers who had deposits in these banks can rest assured, rest assured they'll be protected and they'll have access to their money as of today. That includes small businesses across the country that bank there and need to make payroll, pay their bills, and stay open for business. No losses will be, and this is an important point, no losses will be borne by the taxpayers.
Now, President Biden also went on to say that the executives of the bank should be fired. He said that investors who lost money in the fallout will not be able to recoup their losses. He said, quote, that's the way capitalism works, end quote. And already here in Washington, you're seeing Democrats and Republicans begin to have a financial regulatory debate. President Biden criticizing Republicans in his remarks about rolling back Dodd-Frank regulations. Senator Elizabeth Warren out with an op-ed in the New York Times saying that Republicans should not be advocating to lower capital requirements from banks that the Trump administration had walked back. Republicans that I've spoken with, including one member of the Financial Services Committee earlier this morning, are saying that this raises new questions specifically about which type of regulations community-style banks should be privy to. But all of this, again, as Washington still at just the beginning of what was sure to be a lot of scrutiny over the next couple of weeks.
Yeah, most definitely. And the rollback that you mentioned happened under President Trump in 2018. It was bipartisan, by the way. There were Democrats who signed on to that as well. They said that those regulations were onerous for some of those smaller and community banks. I mean, we don't have the counterfactual, right? We don't know if this would have happened had those regulations been in place. But is there any real discussion of now? I mean, it sounds like that they're at the margins. They're talking about maybe rolling back the rollback. But I mean, what would even be the timeline on this? The House isn't even in session now, right?
No, they're not even in session. And Julie, I can tell you that you're absolutely correct. Republicans were able to get some centrist Democrats on board for some of those walkbacks of Dodd-Frank. So for President Biden to specifically target Dodd-Frank and to have that fight is clearly a progressive populist pitch. It's something that the left wing of his party will definitely like, but it remains to be seen specifically if he will be able to garner some of the more centrist support on that. Look, they're heading into a new election cycle, but a Dodd-Frank debate is something that, according to the president's remarks earlier this morning at the White House, is the debate that he wants to have.
Good old-fashioned Dodd-Frank debate. Thanks so much, Kevin. Great to see you there in D.C.
Great to see you, too.
And as we break down the wider implications of the fallout from SVB, how's it going to affect the financial system overall? How's it going to affect Treasury investments, for example? Exante Data CEO and Market Reader CEO Jens Nordvig is joining us now to discuss. Jens, fantastic to see you today. Before we get into analysis, the data that you crunch at your shop, you told an anecdote on Twitter where you talked about wanting to invest in some of these types of instruments and some people discouraging you from doing so. Can you retell that for us?
Yeah, we raised capital for Market Reader in Q4, and we did have discussions with some VCs about how to place the proceeds, right? And I've navigated financial crisis in the past when I was at Goldman and so forth, right? So I thought the safest thing to do was to buy T-bills for the proceeds that we had. And we had some VCs that opined, not our investors to be clear, that was too risky. So they thought just bank deposit was a bad idea. So We definitely had a shakeup in how people think about risk, and we're going back to good old basics. The T-bills is probably pretty safe relative to bank deposits, and that's a lesson a lot of people have learned over the last few days.
Yeah, I guess it is a lesson we've learned over the past few days. So how does that now change the paradigm for the next several months here? I mean, are we going to see more, if not bank runs? I mean, are we going to see more companies pulling money from banks?
So I think it's important to kind of put the banks in. I'll put them in three groups, right? We have smaller U.S. banks. There's different regulation for banks that have less than 250 billion in assets, right? So SVB was in that group. Signature Bank was in that group, right? The bigger banks, we all know JP Morgan, Citi, Bank of America are much bigger banks. They have different regulation, and they should be dealt with differently and have different capital requirements and so forth. So what you want to see in the market is that there's differentiation between group number one that has been in serious difficulty in causing the Fed to step in and the FDIC to step in, and then the second group of the big banks, right? So you want to see that play out in the market, and hopefully that's going to be the case within a couple of days. The third group is the global banks, right? So last week it was mostly seen as a US issue. What we've seen today is that European banks are down 6-7%, all the big ones there. So there's sort of a reassessment globally. Okay, maybe this interest rate risk that took down a couple of institutions, at least contributed to the failures we've seen, maybe also being global issues. So that's something that's going to be very important for global financial stability to figure out whether that third group outside the US is going to be stable or not stable. And today is the first test of that, really.
Yeah, and says the Federal Reserve just simply broke something here, just given how fast they have moved on rates.
So clearly we've not had a tightening cycle of this nature, right, for many decades. So it's not really surprising that there's certain bank entities that are struggling to manage like the interest rate risk. It is extraordinary that how little hedging seems to have been done in some of these portfolios, right? Literally just keep an open exposure. I find that just very hard to comprehend that has taken place. But interest rate risk is for real, right? And I will also make the point, in the context of the moves you're seeing today, right? So we are pricing in rate cuts. Like half an hour ago, we were pricing in rate cuts for May, right? So a week ago, we were expecting 50 basis points for the March meeting and then hikes in May, July, and so forth, right? And now we're pricing cuts in either it changes every 10 minutes, May or June, right? But it's a huge change.
Is that way off base, though, Jens?
I think the point I would make is that in the past, we've had a situation where inflation was close to target. And as soon as we had financial instability, the Fed focused on that because there was not really a big inflation problem, right? The question is, can they actually do this on this occasion with inflation running way above target? Can they just say, oh, we don't care so much about the inflation target, we're going to cut rates because there's a little bit of financial instability or a lot of financial instability? It's a much trickier decision than we've had in the past because the inflation dimension is totally different from past cycles.
And so, you know, when you said there's a little bit of financial instability or a lot of, like, what? How do we quantify that? How do we get our arms around? It doesn't feel like this is that severe. We're not talking about a financial crisis here, right? It does feel like it's been contained despite some of the stock sell-offs we're seeing in the banks. But I'm saying that like I feel that way. You've got a lot of data at your fingertips. Is that the case?
So when you have deposit volatility, it tends to show up in the stock price first, right? It's not that you get some kind of data points where you say, oh, now the deposit outflow is this and that, and then the stock moves down. The stock moves first. I can remember almost no example from my career where you see the deposit numbers and then the stock moves. It's always the stock that moves first. So like we used the market reader tool aggressively last week, right? To see, okay, Silicon Valley Bank moved in the middle of the week, right? And then it dragged everything with it. We could see that on our screener, and that was very useful. You have to watch the stock price, right? Now the Fed is also watching the stock price, right? So the policy response is being calibrated relative to what's going on in the stock market, and that's going to be very important to watch. And the question is whether there's other policy tools that can be implemented. The problem with Dodd-Frank is that it puts restrictions on what the regulatory agencies can do, and we might need congressional approval for the next step, right? So it's almost like the Fed and the FDIC has kind of done what they can without additional congressional approval, right? And if we need additional steps, we need the politicians to step in as well.
It'll be interesting to see if they do. Jens, great to get your insight here. Jens Nordvig, Exante Data CEO and Market Reader CEO as well. Thanks.
Thank you.
Coming up, the FDIC revealed that U.S. banks were sitting on billions in unrealized losses at the end of 2022. We're going to break down what that means next. By the way, the Dow is in the green. As we continue to cover the collapse of Silicon Valley Bank, we've heard a lot about unrealized losses and other jargon for that matter as well. So I want to do a quick breakdown of what unrealized losses means here. Essentially, it's assets that are held on a balance sheet that are worth less than when you bought them. It's like when you have a house that's underwater on your mortgage, for example. Now, most of the time for companies, that is not an issue because many companies, especially in the banking sector, plan to hold to maturity, which might be another abbreviation you're seeing lately or another piece of jargon you're hearing, HTM. And that's what, in theory, Silicon Valley Bank was planning to do with the securities it had bought, hold them to maturity and so therefore not have to book a loss. However, because it was forced to sell them, it had to MTM, mark them to market, which was what got them into trouble and ended up recording a lot of losses on their balance sheet. To talk more about this whole process and the mess that SVB got itself into, we're joined by Miles Udlin, editor here at Yahoo Finance. So, Miles, this is an unusual situation in part because the instruments that they were holding, that is treasuries and government debt, like this does not tend to happen with government debt as a general rule.
As a general rule. Now, the other part of that conversation you were having around the HTM securities, the hold to maturity securities, banks also have the AFS, the available for sale securities, which are kind of the same things. You will have mortgage-backed securities in there, you'll have treasuries in there. The real problem that Silicon Valley Bank had is because they had this mass inflow of deposits, they didn't have anywhere to put it other than into securities. Usually banks will put a large portion, depends on the bank, you can manage it different ways, into loans. They will extend the loan to myself for my house, right? Your house, you know, what Sazi's car, whatever it wants to be, it's probably financed differently, but you know, whatever it wants to be. And so the thing is, when you take money that your depositors give you and you put it into loans, you are taking credit risk. You are worried the money will not be paid back. When you take money from depositors and put it into securities, treasuries in this case, you are taking duration risk. And what that means is that when the rates change, like when the rates go up as they have, you know, you are underwater on, I think, what their maturities for securities, something like 5 to 10 years, the average yield was 1.5%. Well, today you get 3.7% on a 10-year, you get 5% on a 2-year. So you are taking a loss on that because you've taken duration risk, not credit risk, with the deposits that came in the door.
What happens next, Miles, if the Fed continues to go ahead with its rate increases? That is one of the key debates here this morning. What does the Fed do? You have Goldman coming out saying maybe they won't do anything at their next meeting.
Well, I think the Fed has been laser focused on getting inflation down. And their view, Powell's view, is that if we bring rates up, inflation will come down. Now, the long and variable lags of monetary policy have been discussed in terms of how long it takes for inflation to come down. The other side of it, and we've seen a lot of strategists come out this morning in our inboxes, say the other side of long and variable lags is what it does to the financial system, which gets to the unrealized losses that you're talking about. Now, of course, the key word there is unrealized, and you are not obligated to realize those losses. They are just something that is sitting there. The problem here, and I mean, we can kind of get into this if we want, is like the second that you, whether you're Silicon Valley Bank or anybody else, take a hold to maturity security and sell it, whether it's if it's at a loss, only if it's at a loss, you must then mark the whole book, or you have to mark some of the book to that mark. So now you are realizing the losses on your unrealized losses. And that is when you have a major problem for your earnings profile. That's when you have a major problem for, you kind of look at the moves today in regional banks. I don't think all of it necessarily is that it's going to be like Silicon Valley Bank. It just means the earnings for these companies are going to be massive losses they're forced to realize by selling not only their available for sale securities, but also perhaps maybe selling some of their hold to maturity securities.
Well, and there's also the idea, this is something that the FDIC chair actually flagged in a speech earlier in March, where he, on Monday,
a week ago,
where he said there was $620 billion in unrealized losses. And to your point, the vast majority of those will not be realized, right? Because these banks will not be forced to sell them, but they might be forced to sell some portion of them. I mean, the bank stocks are down for a host of reasons, you could argue, but that is definitely a contributing factor.
Ultimately, the bank stocks are down because the earnings profile for banks now looks worse as a result of this. And a lot of this is kind of accounting, machinations or whatever. But, Sazi, as you know, like when you're an analyst and you're telling someone you should buy this for X times earnings, X times book value, well, if the earnings go down or book value changes, all of a sudden you get a discount on stock price.
Yeah. Market liking JP Morgan, though. Interesting. At least here in the early going. It could change.
Yeah, I mean, I don't think that's a huge surprise though, because again, if you're a bank of that size, if you're a GSIB, you have different capital requirements. The JP Morgan does not have whatever it was, 80% of their deposits in securities. They make loans. Right, they're not allowed to, and that's just not how they manage their risk. Yeah. Also, they have a chief risk officer, which Silicon Valley Bank didn't.
They also have
so there's
Jamie
that
Dimon.
problem.
There we go.
I mean, look, we can go through the JP Morgan thing, but there's a reason why those 12 banks have a very different profile than Silicon Valley Bank and all the others.
Indeed, good stuff. Miles on, appreciate it. Coming up, we'll continue our coverage of the collapse of Silicon Valley Bank all day here on Yahoo Finance, including a conversation with the CEO of Salomon Partners in the next hour. You do not want to miss it. Brian Sazi of Yahoo Finance here, and the fallout from the Silicon Valley Bank collapse is rippling across markets. What we know is this. On late Sunday, the Treasury Department, the FDIC, and the Federal Reserve came out with a joint statement designating Silicon Valley Bank and Signature Bank, a key player in the cryptocurrency banking market, they designated them as systemic risks to the financial system. What does that mean? It means that all depositors in those banks will in fact be made whole. Now, shareholders in those banks will be wiped out and senior management has been removed. So that we all know. Again, there's a very fast-moving situation here. Not often you see bank runs and bank crises like this. Now, there are three themes I think you really need to be looking out for as this situation develops. First, what does it mean for the Federal Reserve's next move on interest rates? Prior to the fallout of Silicon Valley Bank, the Federal Reserve was right on the cusp of potentially raising interest rates by 50 basis points at its next meeting in just a few weeks. A lot of folks that I'm talking to on Wall Street think the Fed may not pull the trigger on a 50 basis point rate hike, likely 25 basis points, given we did have a hot jobs report just a couple of days ago. There has also been some chatter that perhaps the Fed takes a pause in raising rates as a result of the Silicon Valley Bank blow up, which in part was triggered by their efforts to raise rates to control inflation. So that's theme number one. Another theme here that could play out over time is what does this mean and how does it shape future returns for the banks? A couple of folks that I have talked to, they're saying larger banks, it will be made more difficult for them to get capital relief in times of stress. Regulators could even support increasing capital regulations. What does that mean at the very highest level? It means potentially lower future returns for investors in bank stocks. Again, lots can change, but those are two themes to keep on the lookout for. And the third one, I'll just toss this one out there too, as you're sifting through a lot of this coverage, is what is the impact to pensions and endowments? Both of these institutional vehicles look to have invested in startups in recent years. A lot of these startups are now under pressure because of what is happening at Silicon Valley Bank, and as a result of what's happening as a result from the Federal Reserve's efforts to raise interest rates. So just some food for thought. I think those are three key themes that will play out as this situation unfolds. Again, lots of coverage on Yahoo Finance. Be sure to tune in. Brian Sutton, out.
Welcome back to Yahoo Finance. I'm Julie Hyman with Brian Sozzi today. Let's take a look at the latest market action as investors not only mull over the failure of Silicon Valley Bank and Signature, but also look ahead to key economic data this week. Oh yeah, inflation, CPI.
I almost forgot.
That's coming this week too, as we try to game out what the Federal Reserve is going to do next. And we have a host of different reports out this morning with different banks saying they think the Fed is going to raise rates or is not at its next meeting. The S&P right now is lower, but guess what? The Nasdaq and the Dow.
Is that green on the screen?
It's green on the screen,
For
baby.
now.
That's what was happening to the futures after the initial plan was announced that all depositors would be made whole. We'll have to get a check on bank stocks in a little bit to see if they are still in the red. And as we talk about systemic risk and whether that is indeed what is happening, Yahoo Finance's Shauna Smith has been checking on the companies that are affected by the collapse. And as we've talked about, they're supposed to get their money back. But nonetheless, it still raises questions here.
It raises questions. It raises some fears out there, especially on Main Street. Some of those investors out there, the everyday investors, are trying to make sense of all this. So we took a look at some of these larger companies that have reported exposure to SVB, to Silicon Valley Bank. But because regulators, like Julie just said, did approve those plans over the weekend to backstop depositors, we aren't seeing mass panic. Now, a couple of the bigger names with exposure here, we're going to talk about Roku, Roblox, Etsy, and also Rocket Labs here, just to break down all of that for you, because in its more than 40-year history of Silicon Valley Bank, they did develop very deep ties within the tech industry. So let's break down all of that exposure. Roku saying in a filing that it had about $487 million, just over a quarter of its cash with the bank. Roblox had about 5% of its $3 billion of cash. And also space startup Rocket Lab confirming to Yahoo Finance that it had $38 million in deposits with SVB, and that accounts for about 8% of its total cash. And I mentioned Rocket Lab here because that's the smaller of this grouping right here. But like you said, these depositors will be made whole. And because of that, we aren't seeing maybe as mass panic as we would have expected. Rocket Lab shares off just about 0.5%. Yes, Etsy is in the red, but look at that. Roblox actually moving to the upside this morning, up just about 2.5%. Now, Rocket Lab saying that liquidity, it does not expect it to be an issue. They said that in a statement to Yahoo Finance. They do not expect the bank's failure to impact operations. A Vimeo filing also showing that the company had money with SVB, although that account total less than 250,000. Let's also talk about Etsy. That name has been thrown out there numerous times over the last 48 hours or so. Etsy used SVB to facilitate some of its payments to sellers. Now, the company telling Yahoo Finance that it, quote, recently experienced a delay in issuing payments to some sellers, but it does expect to get those sellers their funds within the next several business days. So in this case, the depositors will be made whole, but there's still some worry out there. And that, of course, is reflected in the massive sell-off that we are seeing in some of these regional banks as a number of these startups, a number of these smaller companies rethink how they are allocating their funds. You're looking at losses, 67%, PacWest, Zions, Western Alliance, some of those names halted here in earlier trading. But certainly there is some panic when it comes to the regional plays, guys.
Yeah, most definitely. Panic, I think, is a good way to explain what is going on here.
Absolutely.
Yeah. I don't know what we're doing now. I got a little confused. I got a little lost. Okay, thank you.
Long day.
So
I mean,
much,
the regionals are selling off.
I don't know what's going on.
Day.
Okay, let's talk about. We talked about the banks just now. Shauna was just looking at the banks. I just wanted to check on them again because we are seeing stocks rise right now, but guess what? The banks still are not in the green. So that is not what is pushing us higher here. If you take a look at the Interactive, there it is.
We've got on JPM.
The big banks here. Yes, JPM is now in the red. And then all the regional banks are in the red, too. The only parts of green you see are the companies that aren't trading anymore.
Yes.
We're talking about Silicon Valley Bank and Signature Bank that are both halted, obviously. They're not going to be trading, at least for the foreseeable future. So, but if you go back to the sectors here, I was just curious, what is up? Safety's up. Utilities. Consumer staples, real estate.
Gold caught a bid too as well today as well. Also, yeah.
Yeah, maybe we can take. I'm going to take a quick look at the commodities here, since you're bringing up what's going on with gold and where people are going today. Oil is not higher, that's for sure. But yes, indeed, gold is trading higher 2% today, and silver futures are also up. So that's where people are going. So sort of some of the traditional defensives that we watch in this market. Something else, non-SVB related, that's happening today. Pfizer is looking beyond COVID. It's set to buy a company called Seagen in a $43 billion deal. Seagen, a biotech drug developer where its key products focus on cancer treatment while trying to spare surrounding healthy tissue. And Pfizer is looking to deepen its push into treating cancer as it braces for a decline in sales of COVID-19 products. Pfizer said in its agreement it would pay $229 cash per Seagen share. This is something that's been reported upon and speculated upon here. Interesting, Pfizer initially was trading lower on this confirmation of this deal. Now the shares are up 2%. And we're going to take a deeper dive into this in the 11 a.m. hour. I will be speaking with the Pfizer CEO, Albert Bourla, about this deal, which is a rather large one for the drug maker. Coming up, we're going to break down the risks in the financial system following the collapse of SVB. We'll be right back. Let's do a quick check of the markets now, sponsored by Tasty Trade. As we see, oh, look at that. All three major averages are in the green right now. The Dow, the S&P, and the Nasdaq have all flipped to green. That could change, of course, as the day goes on. But we have seen a lot of money flowing into defensive sectors as well as other assets that are viewed more defensively, as we were just discussing, places like gold here. So it looks like this is not coming because investors are judging that the coast is clear, but rather that they are trying to position themselves defensively. Well, as the largest bank failure since the 2008 financial crisis sends shockwaves through Wall Street, concerns for what the collapse of Silicon Valley Bank means for the banking system, they're making the rounds. Here to take a deeper dive into the threat of the safety and soundness of the financial system is Bethany McLean, Vanity Fair contributing editor. Bethany, it's been a while since we have talked because you, of course, are known quite well for your examination of the Enron collapse and then the financial crisis as well. And so we wanted to talk to you about your perspective here.
Bank, but it is a bailout of the depositors. And the question as to whether that should take place, I think, is a legitimate one. These venture capitalists and their portfolio companies were getting a lot of favors, in a sense, from Silicon Valley Bank, and they didn't do their due diligence either. And they are getting bailed out. It may be a costless bailout in the end, but nonetheless, it reinforces this sense, I think, that the rules are different for different people.
Yeah, and this also brings up one of those phrases that was bandied about so frequently back in 2008, which is moral hazard, right? If you rescue this one cohort, does that encourage future risk taking? Do you think, when companies typically decide who to bank with, they're not looking at the balance sheet, right? They're not trying to figure out what the risk usually at that bank is. Is that just something that needs to fundamentally change?
Well, it's a really good question. I think the phrase moral hazard is very relevant here. And every time the Fed extends its safety net, you increase the moral hazard in the system. And this is an extension of the safety net. Depositors over $250,000 were not supposed to be bailed out. The question, I don't think that small investors, consumers, should have the responsibility of having to do due diligence on their bank's balance sheet. No, but should big companies, should the venture capitalists who did business with Silicon Valley Bank and encouraged their portfolio companies to do all their banking there, should they have done more due diligence? I think the answer to that is yes.
Bethany, as someone that has written on fraud in the past, I believe Enron, is there anything you're seeing in the early going regarding this situation that you would compare to that?
No, except that I do not see any signs of fraud. But I do think that this is, in the end, part of Enron was a failure of regulation. It was a failure of the regulators to keep tabs on what was actually happening. And this, to me, is the big question to me about Silicon Valley Bank. Is this was supposed to be the Fed's responsibility? Not only was Dodd-Frank supposed to address this through something called resolution authority that was supposed to be able to unwind a failing bank without having to do a bailout. That's not obviously what happened here. But the Fed itself was in charge of supervising Silicon Valley Bank. And again, the risk factors that have led to this happening seem really obvious. Hindsight is always 20/20, but they seem like they should have been obvious at the time. Really, really fast growth, which is what Silicon Valley Bank had, is a red flag at a bank. It's a sign for somebody to take a closer look. And so what worries me here is that this does seem to me to be an overarching failure of the Fed, both as a regulator. And I think that's concerning.
The other thing that kind of this reminds me of, and the sort of through line for these various crises that you've covered, is hubris, right? This view on the part of people who are doing this stuff that it can't happen to me, that this is the right path to take, right? And is the only way to clamp that down through regulation?
Well, this would argue that no, that isn't the right way, because Dodd-Frank was supposed to prevent this from ever happening again, and that didn't work out so well. So, it's Einstein, right? The definition of insanity is doing the same thing over and over again and expecting a different result. And if more regulation that was specifically designed to prevent a bank failure didn't prevent a bank failure, I'm not quite sure. Part of the problem to me seems to be that if you fail, if you're big enough to take and important enough to take a lot of things that are important to the economy down with you, then you get bailed out. And that, I was thinking about the differences between this and Enron. So when Enron went down, it went down because Enron wasn't lucky enough to take others down with it. In this case, for Silicon Valley Bank, the failure of all of these venture capital funded companies would have been devastating. It would have been a terrible cost to employees. And so I don't think that regulators had a choice but to step in. And yet the creation of this loop, whereby if you're important enough that your failure is going to do damage to the real economy and ordinary people, then the rules become different. There's something in that seems not great.
Vanity Fair contributing editor Bethany McLean, always good to get some time with you. We'll talk to you soon.
Thank you so much.
Coming up, Yahoo Finance's Brad Smith is stationed inside the South by Southwest conference. You see him there. He's getting a pulse of the VC community post SVB collapse. We're back with Brad next. The South by Southwest Conference is underway in Austin, Texas. This is the fallout from the sudden failure of Silicon Valley Bank continues to weigh on smaller tech businesses. Yahoo Finance's Brad Smith is standing by with us here for more on what he's hearing at the event. Brad, of course, back here in New York City, all eyes on the banking fallout. What are you hearing on the ground over there?
Yeah, we're here in Austin, Texas, where the U Up texts are hitting different as some of the founders and CEOs are really trying to figure out what their exposure to the collapse of Silicon Valley Bank and this bank crisis that we've been discussing throughout the show this morning, what their exposure might be here. And so some of the chills of the different exposure that they're talking about are really only being comforted by the thrills of a few free drink tickets and then additionally some celebrity sightings. But we had some conversations with one such CEO, the CEO of Cipher and Signal and Cipher CEO, who spoke with us and gave us a little insight into the pulse of what he's hearing from some of those group chats among founders, CEOs that are really trying to get their heads around what this means for their own payrolls and just getting into next week. Here's what he had to say.
We don't have a whole lot of time before this starts to have a ripple effect across the entire ecosystem. I mean, we'll see the startup ecosystem is already having an impact. I mean, Monday is D-Day for a lot of companies. And within weeks, we'll start to see shops closing up. And within months, we'll see the ripple effect across the rest of the economy.
Now, some of that action has been initiated. We had, of course, the combined statement that was issued by the Treasury, the Federal Reserve, and the FDIC. That was released Sunday. That approved actions that were enabling the FDIC to complete the resolution of Silicon Valley Bank, Santa Clara, California, in a manner that protects all of the depositors. That from the statement there. And then Monday, of course, this morning, President Biden also issuing and speaking further on the matter, reiterating that no losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. But in one of our other conversations with the DineSafe founder and CEO, Patrick Quaid, he gave us a little bit more insight into what the pulse is of some of those founders that he's speaking with and what the future looks like for them over these coming weeks and months. Here's what he had to say.
If there's not some additional help, some businesses seem extremely likely to fail. Some small, some entrepreneurs and startup companies, it seems clear that will happen unless the recovery is fast and significant. And there's so much uncertainty at present.
Now, here's what's key to remember here. South by Southwest, of course, is typically a fanfarous music festival, also major immersive technology that is really showcased here. And we've been able to get our hands on some of that experience as well. But it is also a breeding ground for some of the deals that take place among founders of startup companies, CEOs of startup companies that are just looking for more funding as well in the near term to bridge them into some of their own brand and company expansion as well. And so they're watching closely what's taking place with this banking crisis at the same time that they're trying to secure more dollars for their future growth as well. But aside from some of those chills, the thrills here, I've got a few of those for you. One of them, we did see Intel CEO Pat Gelsinger. He was here yesterday hosting a Sunday service that with the Grammy award-winning artist Lecrae. We also were able to grab Billions actor Paul Giamatti. In brief passing, I spoke with him and he gave me some insights on where one might find the best waffles in New York City, and the NSFW answer will surprise you indeed. So I'll keep that on my Twitter account. We were also welcomed by the mayor of Austin in a conversation that we'll have for you later on today. Back to you guys in the studio.
So overall, Brad, and it's great to see you there. It sounds like it's going well. So overall, we love to do the vibe check here at Yahoo Finance. So what's your overall vibe check?
The overall vibe check for South by Southwest is that there's still so much of the opportunity in just making sure that there are those connections. I was even sitting down for lunch yesterday and hearing a pitch conversation that was taking place directly next to me. So a lot of the founders that have made their way here for startups and pitch competitions, they're very much looking just for that opportunity to get face time. And so as this has been a conference that for the last couple of years, for 2021, purely virtual, and in 2020, of course, was canceled. 2022 started to make its way back. 2023, it's really been off into the races and really one of those in-person touch points that everyone from founders, or CEOs rather, of mega cap tech companies like Intel, all the way to some of the startups that are just looking for that opportunity to get in front of VCs. And we're going to get the pulse of some of the VCs as well and what they're experiencing. And if they're seeing pitches of companies that are actually recession resilient, we're going to speak with them and see what their vibe is as well. But that is largely been the vibe check thus far, Julie, is that this is the opportunity for a lot of those people who missed out on those connections and in-person opportunities over the past couple of years to once again finally have that meeting point. And there are plenty of those to be had here at South by Southwest in Austin, where of course they're trying to rival Silicon Valley with their own Silicon Hills here. And we'll have more of that discussion later on.
Well, it seems like that's been working. They've had a lot of growth there. Looking forward to your coverage all week, Brad. We'll check in with you as the week goes on. Coming up, how the meltdown of Silicon Valley Bank will affect the state of startups more broadly. We'll discuss. Silicon Valley Bank built a banking franchise around startups, becoming the go-to bank for venture stage companies that were not yet profitable. In the wake of SVB's collapse, where do the tech startups go from here? For more, we're joined by Natasha Mascarenhas, senior reporter at Yahoo Finance sister publication, TechCrunch. Thank you so much for being here. So where do they go? Like, does funding just dry up entirely? Are there other institutions that are now going to cater to these companies? What happens?
Thank you for having me. I think a lot of people are forgetting that there was already a downturn. And so it feels a little bit like the downturn collapsed and startups that were already struggling are going to be struggling a lot more. So the two big questions that I'm hearing from startup founders is one, where do I keep my money now that my trust has been broken and I'm getting conflicting advice from my venture capitalists, from the markets, from other startups? And two, I mean, is this going to happen at other banks? I know over the weekend, I spent a lot of time reporting on founders and VCs putting up their own personal capital to help meet payroll, which set aside a ton of legal questions and implications. And so that just gives you a taste of how frenetic the past weekend, let alone 4 days, was in Silicon Valley. So many questions from founders on the simple things, just like paying their employees, let alone, acquiring companies or disrupting AI.
Natasha, well, where does the money go from these VCs? They can't hide under their bed. Maybe they could.
So, before, like I said, I think we saw venture capitalists being a little bit more risk averse due to the state of the economy. I think fundraising, from what I'm hearing, is definitely going to be slowing down as people evaluate their next steps. And from founders I'm speaking to, the general advice is decentralize where you're keeping your capital. Do not put it in one bank, even though we understood why Silicon Valley Bank, the fact that it was with over half of US startups because of the way that it worked with them. Good for them. But now that it no longer exists, you need to diversify. That is the top advice I'm hearing. As for venture capitalists and how eager they are going to be on spending their own money, I think it has to either come from pressure from their own investors or a even bright spot from a startup. But let's just say, I don't think the investing is going to be happening super eagerly or at all like 2021.
Yeah, it definitely feels that way, Natasha, as we look at these companies and what they're going to do next. As you mentioned, there's already been a slowdown in the industry. But at the same time, it feels like another bank is going to see opportunities here to maybe tailor itself to these companies. But the companies that you're talking to, the founders that they're talking to, like usually when you figure out what bank you're going with, you're not worried about their solvency, right? That's not usually like a criteria that you're ticking off of your checklist. Is that changing for these founders? I mean, if they are shopping for another bank, you have to wonder if they're going to be applying a different lens.
100%. I think a lot of people became banking experts overnight. And so a big question still have to be answered. But just to give you a sense, I think the immediate question when SVB started to collapse was, okay, what does this mean for the banking startups that have been gearing up for this moment? That conversation started and we saw an influx of one company, Brex, get over $1 billion in demand from startups looking for its emergency credit line, representing over $10 billion of the deposits that were then locked up in SVB. That conversation just as fast turned over. Maybe you want to go to a private tech startup, but if you're a startup, do you want to go to a private company or do you want to go to a more traditional looking bank? This is probably not the time per some investors that you should be risking with a private company. And so I think there's a lot of questions and honestly uncertainty. Venture capitalists, like I said, are contradicting each other a little bit here. We're already seeing some of the alternatives that people were talking about, including First Republic Bank, Western Alliance, and PacWest, down 60%, 66%, 45% in their trading. And I think that gives you a sense of people don't really know where to go next. It just looks like they've just spread it out, which, I wish there was a more clear answer or place to go next.
Great insight here. TechCrunch senior reporter Natasha Mascarenhas. Good to see you as always. Appreciate it.
Thank you so much.
All right, for more on how the SVB collapse is being felt throughout the tech industry and banking industry, we're joined by Solomon Partners CEO Mark Cooper. Mark, always great to get some time with you here. It's been a challenging few days, to say the very least. What are you hearing from clients at this moment?
We're hearing a lot of concern about the banking system. I was happy to see that the Fed jumped in and secured deposits, because these are classic run on the bank issues that without confidence, we could see a number of banks suffer. So putting the confidence back in the banking system that depositors aren't going to lose their hard-earned money is extraordinarily important. And so what happened here is a bank which technically wasn't insolvent became insolvent because of a complete imbalance between their assets and their liabilities. Short-term money that was a flight risk, and long-term investments that they had no access to.
Mark, this environment was already a tricky one for M&A, for what you do, right? Given rising interest rates, given uncertainty in the economy, what does this then do layered on top of that?
Good question. It's never good until for the immediate future, although you saw a very large transaction happen today, $42 billion transaction. But for the immediate future, it's gonna be a negative until people sort out what the future of the banking system looks like. Now, no one believes the banking system is in jeopardy, but there are certainly a number of banks out there. We've mentioned a few in your broadcast that are concerns to people. And again, not because they are fundamentally mismanaged or because, in fact, they are insolvent. This is nothing like 2008, where banks and investment banks were investing in securities that really, at the end of the day, had no value. Here, it's just a question of fear. It's a question of the classic run on the bank. And if you pull out short-term deposits, because again, banks borrow essentially short with deposits, and they lend long or invest long, either with loans or with buying government or other securities. So this is going to be a negative to the market. I would say credit would probably pull in a bit, although credit has been tough over the past number of months. Our view about M&A is it's sort of like there's a pending demand. Someone likened it to a car crash on a highway, and the cars are backed up, but eventually that crash will be moved, and then a lot of cars will go through. That's particularly the case for the private equity funds, who are sitting on a number of businesses they want to monetize. They want to return capital to limited partners. And so I think we'll see it pick up. It also could have been, maybe I'm an optimist here, but could this be a deflationary event that causes the Fed to pause a bit? Part of the issue about M&A is having certainty on interest rates. And with the Fed continuing to raise interest rates, no one really has a sense of where it's going to end. So how do you price securities? How do you price companies? Having that stability, or at least the view of what will happen in the future, I think will start opening up the markets. And as you know, it's all about price. And right now, there's just simply a disconnect between buyer and seller.
Mark, does this also consolidate power in the financial services industry when it comes to deposit-taking banks? Do you and your companies that are your clients need to rethink who you're working with, or does this kind of remake the industry in that way as well?
It's unfortunately the case. I think you're right, Julie. I think the issue is people are gonna, as they always do in trying times, it's a flight to quality. So they're going to end up going to the biggest and most well-capitalized banks, which longer term is not a great thing for our banking system, because we don't want to have too much concentration. And these banks do serve a purpose. Silicon Valley Bank served a great purpose for 40 years. Now, having said that, again, it has to do with the right kind of management. When you have $150 billion in deposits coming in a year and a half, on top of an original balance of 50, and you don't keep a lot in liquidity, well, that's not a smart move. And so I think people have to be very cautious about where they're putting their money in. Having said all that, I hope this passes. I hope that confidence has been restored in the financial system. I hope people believe that they're not going to lose their deposits at the end of the day. And the bank system is about confidence too. And we're hoping that this passes. Are we at the first inning or are we at the eighth inning of this process? And the answer is I don't know. But generally speaking, what we've found in the past is they don't end quickly, right? These tough times don't end quickly.
Mark, given this situation, have you made any changes to how you think about running your own business?
Well, sure. I mean, as a steward for my partners and my investors, I do think about where our capital is. In fact, our capital is at First Republic, and we've not done anything about that other than monitor the situation. We feel comfortable that they have the adequate liquidity to support the business and support their depositors and their clients. And so, but you do think about these things, and we've seen clients who have moved their capital to other banks, other well-capitalized banks. I think to name First Republic, I think they made some of the right moves because it is about liquidity. One of the mistakes you could say about Silicon Valley Bank is should they have been more aggressive about bringing in equity capital earlier last week or weeks before that. And we often see, as we saw in the Lehman Brothers situation, is people don't really accept the fact that their stock could go to zero, and they don't accept the fact that getting life-saving capital preserves value. But as you saw in First Republic, while it wasn't equity capital, they have raised a considerable amount of liquidity in $70 billion on a $200 billion or so depository base. That seems like a fair amount of liquidity.
Mark, real quick before I let you go on First Republic, you're leaving your money there. You're not pulling it out.
I am. No.
Okay. All right. Solomon Partners CEO Mark Cooper, always good to see you. We'll talk to you soon.
Pleasure. Thank you.
Coming up, we'll go international to the state of U.S.-China relations off the SVB bank blow-up with the strategist from Macro Lens. That's next. Silicon Valley Bank failed on Friday, and since then, several startups, Bill Ackman and what seemed to be all of Twitter, called on the U.S. government to prevent a nationwide collapse in the banking system. Chinese tech startups also held accounts at Silicon Valley Bank, especially those with dollar funding. While this high drama plays out, some say U.S. regulators could learn a few things from China on how to police the banking system. For more on all this, let's get to Macrolend's chief strategist and managing principal, Brian McCarthy. Brian, good to see you here. How do you think this situation with SVB Bank and even Signature, for that matter, will impact U.S.-China relations?
Sure. Well, it's bad for the Chinese economy, that's for sure. Whenever global liquidity tightens, China, through its still managed exchange rate with the U.S., really struggles to prop up its economy. The Chinese economy is already struggling despite a lot of optimism about its economic reopening after the COVID zero policy was lifted. But I'm not really all that optimistic on Chinese growth prospects this year. We had the new premier of China talking fairly pessimistically about the low 5% growth target they set being difficult to reach because of the problems the Chinese economy is facing. So should the banking problems in the US morph into a broader global liquidity tightening like we saw in 07 or 08 or 2011, 2012, and again in 2015, 2016, these tend to be very stressful times for the Chinese economy. And then, of course, we're in a very tenuous situation in terms of U.S.-Chinese relations, really centered around what's going on in Russia and Ukraine, with the two major powers on opposite sides of a proxy war. So you overlay global economic stress, if that's what we're now looking at, and it really becomes a fraught situation.
Yeah, I mean, I guess there's some level of global economic stress from this latest situation. I have to wonder, Brian, if we might get a little gloating from the Chinese even, because their banking system is more tightly controlled, particularly on the smaller bank side where more risk there resides. And so you have to wonder if they're going to say, well, you don't see that happening here.
Sure. The way the Chinese system works, if you thought the moves that the Fed and the FDIC and Treasury took over the weekend were heavy-handed, well, China's that times 100. It's full moral hazard on the one hand. Everything's deemed to be protected by the government, but with a very, very heavy regulatory hand, which, as an aside, they are using to tighten credit. So the days of credit-fueled growth in China are over because that process created vulnerabilities that Xi Jinping now sees as problematic in this sort of battle he sees himself fighting potentially in a new Cold War with the West. So China is using that regulatory apparatus, which, by the way, they just retooled in last week at the National Party Congress with the institution of a new oversight body reporting directly to Xi and his minions on financial regulation. So China also is tightening credit in a way that's going to be very, difficult economically. But because it's been dealing with similar situations, for a number of years and sort of kicking the can by adding credit. Now, Xi Jinping has no one to kick that can to, so the problems are starting to be addressed. So it is a similar dynamic on both sides at this point.
Is China doing anything good on the regulatory front here, Brian, that the U.S. may want to adopt in some form or another?
Oh, no, I wouldn't look to the Chinese model by any stretch. China has accumulated credit at world historical rates, and it's far from clear that they're going to be able to sort of halt and then reverse that process without some kind of dislocation at some point. So you've got a Chinese banking system at, call it $60 trillion, 3 times GDP.
But
just about.
Brian, they banned cryptocurrencies. Does this fallout from SVB beg the question that we should be moving tougher and quicker and get tough in terms of crypto regulation?
I wouldn't blame crypto for the fact that we've had the sort of probably the most aggressive U-turn in Federal Reserve policy in a short period of time in our history. Now, we had a pandemic, so it was all understandable that they acted incredibly aggressively, but then they reversed incredibly aggressively in very, very short order. It's almost inevitable that you're going to blow, some kind of bubbles that are going to be disrupted when that happens. So many commentators, I would say myself included, have been pointing to the inversion of the yield curve and saying the Fed's gone too far here. This is going to be a problem. So I think that's really the root of what's gone on, is the wild instability in monetary policy. And again, you can defend it because we had a 100-year disruption to our economy. But that is really the root of what's going on. And it was just more than the regulators could handle. Not that there weren't regulatory problems, but unfortunately, the response is probably going to be even more heavy-handed regulation. So what we're looking at now in the U.S. is every banker in the country is in a defensive posture now. And we were on the cusp of credit contraction in the U.S. as it was. So bank credit is barely growing over the last few months. So now we're going to be looking at a credit crunch. And more regulation to come, I'm sure. But in my book, the root cause of this was just the wild instability in monetary policy over the last 3 or 4 years.
Well, doesn't feel like a great scenario, does it, Brian? Thank you so much for being here. Appreciate your insight. Brian McCarthy is Macro Lens Chief Strategist and Managing Principal. Good to catch up with you. We'll talk again soon.
Thank you.
Coming up, we'll continue to follow the collapse of Silicon Valley Bank. But how did we get here exactly? We're going to have a tick-tock of the events that led to the collapse and today. Next. We have talked in sort of big terms about what led to the collapse of Silicon Valley Bank, but we wanted to now zero in on the events of last week and sort of a timeline of how exactly we have come to the place we are today. Actually, last week, the CEO of Silicon Valley Bank spoke at a Morgan Stanley conference. It sounded like business was usual, if a challenging environment, as we know, which it is for tech. And then late on Wednesday, the company announced that they were going to be raising capital through a three-part share sale. First, just a sale of common stock. Second tranche was a convertible offering. And then third, they were selling it directly to a venture capital firm. And that's when the stock started to wobble, when we got the news that they were doing that. And then it came out why they needed to raise that capital, the fact that they had losses on a number of instruments.
And then the withdrawals began, and ultimately we're here on Friday. SVB shares were halted. California regulators intervened and shut the bank down.
And that's effectively because a bank run was occurring.
Yes.
This is when
The lines were out the
depositors
doors.
rush. The lines, right?
lines.
The online lines, I guess you could say. You had the likes of Peter Thiel, who was encouraging his portfolio companies reportedly to pull their funds from the bank. And then that just snowballed and created a bank run, which always makes me think of It's a Wonderful Life and the classic bank run of people clamoring to get their funds. So that's what led then to the government shutting down the bank. There was a lot of speculation about what would happen next. Would it be like we saw during the financial crisis where pieces of it would be auctioned off to larger banks? That ultimately, however, is not what ended up happening.
No, and then by Sunday, Julie, of course, you had what I think a lot of people didn't realize. Signature Bank was closed on Sunday. So that came out in that joint statement with the Federal Reserve, the FDIC, and the Treasury Department. The U.S. government stepped in and says people with funds deposited at SVB will be able to access their money. And then come today, Julie, we have President Biden speaking, saying the banking system is safe and all of these stocks are under pressure, notably First Republic.
Yeah, First Republic in particular. We just talked to Mark Cooper over at Solomon.
Leaving his money.
Yeah, who has his funds there at First Republic. And the Federal Reserve not just saying depositors are going to get the money back, but creating a new backstop as well for banks that are still out there. Something I forgot to mention is we did get a credit downgrade of SVB last week. First, Moody's warned the bank it was going to be potentially downgrading it. Then they did the share sale in order potentially to stave off that downgrade, but part of its debt got downgraded, and then a full downgrade came from Moody's and S&P Global by the end of the week. So that also helped weigh on the sentiment surrounding the bank.
It's going to be a long week, Julie.
It's going to be a long week. Probably not as long as the weekend was, though, I would say. As we look at stocks right now, we are seeing them in the green, but really we've been bouncing between gains and losses, that balance between people going into defensives and getting out of the financials and what are viewed as more cyclical or risky areas of the market. Right now, that balance is green. And coming up, Michelle Okuvo is going to continue our coverage of the collapse of Silicon Valley Bank. Plus, don't miss my interview with the CEO of Pfizer on that big new acquisition of Seagen. All that coming your way in the next hour.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Rochelle Akufo. Here's a look at what I'm watching this Monday morning. The Silicon Valley Bank fallout. A volatile trading session sees major indices fluctuate between gains and losses. Bank stocks still under pressure. President Biden says the U.S. banking system is safe and deposits are secure. And contagion fears. We'll take a deep dive into the crypto sphere after regulators seize Signature Bank, a key lender in the space. We'll speak with a Web3-focused venture fund and the head of one of the last remaining big exchanges. And of course, we'll get the latest on Capitol Hill as lawmakers start to round on the second biggest U.S. bank failure. We'll speak with Representative John Garamendi this hour. But first, let's check in on how the major indices are faring this morning. They've turned from negative to all three in positive territory after some sell-off this morning. But now we're seeing gains here for the Dow up about 187 points. The S&P up about 18 points on the day, about 0.5%. Tech-heavy Nasdaq, they're also up about 0.2%. At least quelled somewhat by that government intervention in SVB, and at least giving some of those worries a little bit of a lay there. But let's also take a look at what we're seeing with treasuries as well, because we did see investors piling in for some lower risk options, sending the yield on the treasuries plunging this morning. You see there, the 5-year down almost 9.5%, the 10-year down about 6.5%, the 30-year down about 2.8%, and we saw the 2-year falling to 2008 levels at one point. Well, U.S. financial regulators took action this weekend to stabilize the banking system. That's after the sudden collapse and seizure of Silicon Valley Bank. Now, the Federal Reserve, Treasury Department, and FDIC assured all customers will have access to their money held at the bank starting today. And the same goes for depositors of Signature Bank. Now, the sudden failure of SVB took place after it couldn't meet the demand of panicked clients as they tried to withdraw $42 billion from the bank. President Biden made remarks this morning to the American public, emphasizing the U.S. banking system is safe. But what do markets have to say? Here to discuss is Catherine Rooney-Vera, Baltic Capital Markets Head of Global Macro and Chief Investment Strategist. Good to have you on the show. Obviously, been quite the roller coaster here. You weren't sure if markets were going to buy what they were hearing from the government on this. But we are seeing, as we've seen, all three major indices now positive. So if this isn't a systemic issue, as we did see in 2008, how would you characterize what we're seeing at the moment?
Well, it's definitely, part of it has to do with the Fed having increased rates 500 basis points over the course of about 12 months. And banks and credits, issuers, especially high yield or junk issuers, those that have, such as in the case of Silicon Valley Bank, poorly managed their assets and liabilities and taken on too much debt or made themselves vulnerable to the tech space. Again, in this case, I think that's exemplified. They're going to face fragility and defaults. And that's part of the economic cycle, Rochelle. We've had a Fed that has kept rates artificially low for an extended period of time. The Fed also back in 2020, and I think SVB probably believed this, said that the inflation was transitory and that we shouldn't worry and that inflation wouldn't get out of hand. And we really wouldn't need to worry about rates going much higher. So what happened? We have this asset liability mismatch rather, and it has been massively a losing proposition, let's call it that way, for a lot of these junk entities. And I think we should expect to see more of that in the small bank space, as well as in emerging market issuers and high yield names. So let's expect that. That's part of the cycle. And that's part of a Fed that has increased interest rates so dramatically after keeping them so low for an extended period of time. I don't think it's a systemic risk to the financial system. We should not compare it to 2008. The conditions are decidedly dissimilar. They're not the same. And let's face it, we could have a FDIC that backs up all the depositors, yes, but we're not talking about bailing out, corporate execs. We're not talking about bailing out credit bondholders or equity holders. This is a backstop to the deposits. And I think that they did the right thing in doing so.
But I mean, when you see how fast the tech space had grown, especially during those historically low interest rates, you saw SVP deposits tripling between 2019 and 2021. Right. Should some sort of alarm bells have gone off when you do have so much exposure to tech, which is so sensitive to interest rates? Should red flags perhaps not have gone up a lot sooner?
Yeah, they probably could, but it's so easy to look back and judge. I mean, right now we have alarm bells going off and people are underestimating the risks. I mean, you hear a lot of economists talking about soft landing when really I think it's more of a pipe dream than anything else. So at every point in time, Rochelle, we have underestimated risks. And we in the future could be looking back on now and saying, how did we not see this, right? You have an equity market that's trading at 18 times forward earnings when we're on the precipice of recession. We have a Fed that's going to still have to continue hiking rates because inflation is 3 times the target. Yet Fed fund futures are expecting no further rate hikes from now through year end. Yes, in part because of SVB, but they're expecting now cuts. So I think there are some massive dislocations in the market right now that are being underestimated. And that's why, Rochelle, I am recommending to our clients, both institutional and retail, ever since the beginning of the year, honestly, that they park some cash in instruments that I think are pretty juicy right now. We can look at commercial paper or T-bills that are yielding around 5%. Not today, they were. They've fallen slightly. But certainly that's risk-free assets that I think compare favorably, Rochelle, with the equity risk premium, the risk that you're taking to assume equities. I think it's favorable for cash equivalents, and fixed income instruments at this juncture.
And you raise a fair point. Obviously, a lot of red flags going in opposite directions, and markets don't seem to be pricing in that risk as well as they should. I want to ask you about global ripples, though, coming from this fallout from SVB. I mean, we saw the UK approach, HSBC, buying the UK arm for £1. So what are the expectations for global ripples here? How contained do you think this should be?
It's a good point. I think that that it should be relatively contained, but as I said, the bad apples I think are going to get shaken out, which means paper issuers, corporates, banks that are financially unstable and unable to weather the storm of massive increase in interest rates. So I do expect, and I reiterate, this is a natural part of the economic cycle. One should expect entering into recession or in recession, which could perhaps be precipitated by Fed rate hikes, one should expect there to be difficulties with repayments from some of the lower quality issuers. So that hadn't happened yet. It's starting to happen, and I don't think we should discard the possibility. In fact, I think we should fully expect that to continue to occur. And I don't think that the Fed should backstop everyone, and they probably will not. There will be a lot of small entities and perhaps junk bonds that will default or go under. And as I say, that's part of the economic cycle. I do think that there will be opportunities to enter. There are names, there are banks in Europe, for example. The baby is going out with the bathwater here. You have everybody falling out of bed. So I think it's a good opportunity for investors to look for names that are structurally sound. I mean, a lot of that money, Rochelle, that is being, backstopped in terms of the deposits has to find a home somewhere. So it's more likely than not going to benefit the big banks that are more healthy and financially sound.
And while it does raise that moral hazard question is who should be getting the special treatment, who should be getting the backstops and not, also another focus is what this means for the Fed. Most think they're going to keep the trajectory, that they're going to continue with the rate hikes. But what's your take? Because some people are expecting perhaps a pause or are waiting for the medicine to kick in once we have something like what we've had with SVB.
I think the market is in for quite a shock when it sees that the Fed perhaps does stay higher for longer, but then resumes rate hikes, not rate cuts. Why? Because inflation is sticky. You have the sticky component of inflation from the Atlanta Fed still moving higher. You have core inflation, which is X energy, X food, and X shelter costs, also sticky and accelerating. So inflation has some real concerns, and I think it should concern the Federal Reserve. The labor market remains overheated. So I think the Fed's going to continue to hike, perhaps not in this meeting, down the line, once we get some stability on this financial front, which is the current panic. But I do suspect the Fed has to return to basics, back to basics. They have a dual mandate, full employment, and 2% inflation, and that is their target. They must get there.
Certainly doesn't help coming off one black swan event than to have another also roped in as well. But a big thank you there to Catherine Rooney-Vera, Baltic Capital Markets Head of Global Macro and Chief Investment Strategist. Thank you for your time this morning.
Thank you.
All right, coming up, how the collapse of Silicon Valley Bank is impacting crypto. We'll discuss next. USD coin, which is pegged to the US dollar, in focus today after Circle, the issuer of the stablecoin, said that the $3.3 billion it held with the now collapsed Silicon Valley Bank will be fully available. Yahoo Finance's Jen Schonberg is following the story and has more. Morning, Jennifer. All right, well, let's check in with our guests now. We're going to have Sam Yilmaz, Blockcelerate co-founder, general partner, and COO joining us, trying to get this venture capitalist view of what happened here. As you watch, as the events have unfolded, and even the sort of confidence that you're seeing in the USDC, what are your biggest takeaways from what's been happening over the last 24 hours?
Yeah, the biggest takeaways is that Fed has made whole on its social contract that, in fact, US dollar can be a reliable means of measuring value and transacting. And it's basically now a train wreck that didn't happen, that value didn't get lost, deals can still happen, and innovation can still continue. We still are invited. Go ahead.
Well, I was going to say, we saw from Gary Tan, the CEO of Y Combinator, he actually tweeted calling this SVB fallout what he called an extinction-level event for startups. Now, this was before the government intervened, but where should the responsibility lie in really getting into this position in the first place?
Yeah, I think you have a point there. As users, as venture capitalists, we're expected to be the clever kids, right? Maybe we should have done more due diligence before we put all of our fund and startup companies' capital in SVB. And we're in an evolutionary phase. Eventually, we will have on-chain records of immutable transactions, of auditable transactions, that we can see the history of all asset movements, but we're not there yet. So as we are midwives to that change, we end up having to use the legacy financial infrastructure at times. And this was one such crisis born out of that.
Because it really does show that sort of spillover. You have this decentralized decentralized banking and things with crypto itself, but then the companies that are actually supporting them still relying on the traditional banking system. But I mean, as we look at some of the crypto prices today, pretty much all of them in the green. We see Bitcoin up about more than 17% on the day. Is there a correlation then between the fallout that we're seeing with SVB and Signature Bank and what we can expect with crypto prices, given how they're reacting?
Yeah, I think the general sentiment is a function of on Friday, on Saturday, a part of Sunday, we didn't know, hey, are the money deposits in one of the top 20 financial institutions in the US safe? Will we be able to get back to business as usual? And that kind of shock invites people to consider other alternatives. And ultimately, on-chain solutions give us greater certainty that our assets will be there and we'll have the ability to command control over them. And it speaks volumes that market is picking up on the value proposition of cryptocurrencies and showing a buy signal.
So do you think that this shows that obviously a lot of people looking at this decentralized banking, does it really perhaps validate it somewhat once we've seen how subject some of these banks can be if they don't have the proper oversight when it comes to being overly exposed in one specific sector?
Yes, it does validate the value proposition of on-chain transactions and the ability to have a measure of value, a unit of account, and ability to transact basically without interruption, without having to rely on third parties that might go out of business, that might lead to seizures, that might lead to confiscations of different sorts.
So then, Sam, how would you compare the credibility of what we're seeing with stable coins versus crypto?
Yeah, so stable coin prices and the temporary depegs we've seen are a function of how a live market reflected in loss of value in stable coins, the possible loss in bank stored assets. So the narrative is the stable coin is backed by the dollars in a bank deposit, and therefore in the case where there was scrutiny and possibility of losing assets stored in a bank, so did the market price of the stable coins reflected that. In the case of native crypto, look, I've invested in Bitcoin in 2013 and Ethereum in 2015. So to me, it's obvious that these immutable, opt-in, free to use by anyone kinds of systems are far superior to the historical legacy systems we've used. And this is a testament to that.
Certainly a wake-up call indeed for the banking system these last 24 hours. Sam Yilmaz, Blockcelerate co-founder, general partner and COO, thank you for your time this morning.
Thank you for having me.
All right, well, let's keep the conversation going now on what the fallout from the SVB episode on the crypto industry is. Joining us now is Anthony Trenchev, Nexo's co-founder and managing partner. So I want to ask you, Anthony, as you're stepping back and looking at this, what is your big takeaways from what's been happening over the last 24 hours and perhaps some of the lessons that could be learned from this?
I think there are very important lessons here, and it's a few of them. And let me start off by saying I don't think we are out of the woods yet for a couple of reasons. First of all, we are seeing a flight into Bitcoin and Ethereum because people want to escape some of the smaller caps and some of the stable coins that are out there. So there is this internal rally within blockchain, the blockchain space, okay? Then secondly, I think an important lesson is that this particular crisis in crypto, and we as an industry have our fair share of sins, especially with the unraveling of last year, that has become clear. But I don't think this particular crisis, it is the blockchain industry as such to blame. This is like, USDC, they did everything right. They placed dollars in a federally insured bank, the 60th largest, and that created the commotion. And then the third important takeaway is that obviously the regulators and politicians in the US are not as excited about crypto as we thought they are a few years ago. And I'm saying this euphemistically because what we are seeing is going to have repercussions and second order effects for a very long time within the industry.
And I mean, we're still seeing the fallout from FTX as that continues to unravel. But do you think we'll see the same sort of contagion or the same sort of domino effect after the breakdown now of Signature Bank and SVB as well?
Well, with Signature Bank, it was a total surprise. From what I heard, even the executives, they found out that Signature is going to be closed out just 5 minutes before the Fed issued their press release. I do not know what exactly was wrong at Signature Bank, and I'm no fan of conspiracy theories, but it's obvious right now that the blockchain space has very limited access to fiat, and that the banks that were servicing the space are all but gone. There are a few small ones left there. And this is of some importance for a number of reasons. And I think a notable one is the fact that new money, if it wants to come into the space from US dollars to, crypto native assets, will have a really hard time. So, the second order effects of the shutoff of the fiat ramps will be felt in the months to come. It really depends on what the regulators have in store for us. And by the way, this is the reason why foreseeing this 18 months ago, we started to exit the US market in an orderly fashion and replace that market share with other regions of the globe.
So then what are Nexo's customers doing in light of this, and how are you positioning the company?
Well, I think as a company, we are in a very strong position financially and, just as products and services, because they are devised by what we see demand by our clients. And, weaker hands have left the platform during the course of 2022. So we have hardcore fans are the only ones left. What they're doing right now is they are on the sidelines. They are waiting to see how this plays out and are ready to be deploying capital because, a lot of people, certainly some of the larger whales that I personally am in touch with, do see this as a bear market rally, despite the fact that Bitcoin is up, I don't know, probably 17% on the day. But as I started, this is a flight to quality from some of the other assets and, a lot of money on the sideline, that's for sure, and it will be deployed. But I think at slightly lower levels than where we're currently trading at.
And so I want to also ask you about Fed reaction to this. Obviously, we saw the government step in, making some special exceptions here in terms of backstopping these sorts of accounts. What does that mean for crypto? Once you have that precedent start to be set, is that a good thing for crypto?
It is a confusing thing for crypto because, we had Janet Yellen saying something and but President Biden this morning contradicting her. And, it is unfortunate because it turns out that regulation and having watchdogs regulate the entities does not stop bad things from happening. I'm talking about the banks because this is always the critique about, crypto companies. Oh, they need to be regulated, to be managed, they need to be with proper checks and balances. And what happened with all of that in the sector? Because what we saw is the fact that depositors are getting their money back is not because of stringent risk management by the banks and prudence, but it is because the federal government is stepping in and is guaranteeing everybody's dollar. So I think that speaks volumes about structural problems. And this will have some effects on the industry, most notably what we talked about, the on and off ramps. And, but one of my favorite things about crypto as such is the ability for startups to fail and fail quickly so that the good actors can succeed, the bad apples can be sorted out. And this is what fosters innovation, I think. And over the past few years, we haven't seen that possibility in traditional markets. Yes, it's painful, but I think it's a cleansing process, which is a net positive.
A cleansing process. That is definitely a good way to look at it. Anthony Trenchef there, Nexo's co-founder and managing partner. Thank you for joining me today.
Thank you.
All right, well, turning now to Yahoo Finance's Jennifer Schonberger, who's been following this story all day and has more on this. Hey, Jennifer.
Hey there, Rochelle. That's right. Just spoke with Circle's Chief Policy Officer and Head of Strategy, Dante Disparte, who is urgently calling on Congress to pass legislation to regulate stablecoins in the wake of Silicon Valley Bank's failure that led their stablecoin to break the buck. In a conversation just moments ago, Disparte saying that he favors legislation from House Financial Services Committee Chair and Ranking Member Patrick McHenry and Maxine Waters. Disparte telling me, quote, I have been uploading dollars to the internet since 2019, and since 2019, there has been an ongoing persistent conversation about risk, and we've been met with complete inaction. I do think if this is the digital assets Dodd-Frank moment, then it is the time to act. Just as it took 2008 to get comprehensive banking reforms, I think it's well past time that the U.S. acts. And to act is not to ban innovation, it's to encourage responsible innovation. But there is a shortfall in action right now. Now, Disparte also told me it was a run on a bank that triggered a loss of confidence in a fully reserved digital dollar. He says that's the irony. Whereas with the Terra Luna blowup, he called that financial alchemy of the very worst kind. He says the way Circle operates is more conservative than the PayPals of the world, and it was a loss in confidence in a bank that triggered a crisis and risk in Circle's business. Now, Circle's stablecoin broke the buck after it revealed that it had a $3.3 billion in reserves tied up in Silicon Valley Bank, causing investors to dump the stablecoin. Circle pledged from its balance sheet over the weekend to make any holder whole if the bank didn't go through an orderly wind down, and that helped to restore that DPEG on the chain. Circle holds 80% of its reserves in short-term treasuries and 20% in cash. As a depositor of Silicon Valley Bank, Circle will be made whole by the FDIC. Now, Rochelle Disparte told me that there is a serious policy conversation that needs to be had here, and that regulators' intervention over the weekend was the right move to stave off contagion. I will have more on this on our website on finance.yahoo.com. Rochelle?
All right, appreciate that update. Jennifer Schonberger there for us. All right, checking in on the markets here, sponsored by Tasty Trade. We're seeing all three major indices touching session highs at the moment. The Dow up almost 250 points there, 0.76%. The S&P 500 there also up about 0.8%, 30 points so far this morning. The Nasdaq up 1.3% there, up 145 points on the day, but still seeing the banks, the biggest laggards sector-wise, as we're keeping an eye there as well. All right, founded in 1983, Silicon Valley Bank has been a key driver for success in the tech industry, working closely with venture capital-backed startups and claiming to be the, quote, financial partner of the innovation economy. Still, as it collapses, the impact will be felt throughout much more than the tech industry. For Main Street's take on SVB's collapse, let's get to Yahoo Finance's Ali Canal. Hey, Ali.
Hello, Rochelle. And right now, the sentiment on Main Street, on Twitter, it's very poor. I would give it a very ugly vibe check right now. We're also seeing that reflected in the stock market with certain regional banks like First Republic taking a big hit today. Here are some initial reactions that I pulled from Twitter. One user in particular focusing on the panic that started this, writing in part, quote, the reality is the banking industry has to start adding this, quote, social media risk into their frameworks and find a way to get ahead and control the narrative to avoid this type of situation from happening again. So basically calling for firms to have a stronger social media presence and really communicate with consumers where they are. On the other hand, we had one user highlighting how customers should be better educated on how this system works, tweeting, quote, SVP, poor risk assessment and poor management, though depositors should have been keeping better eye on how the bank was being managed. In my opinion, if you've got enough money to keep it in a bank, you've got time to check up on who's managing it. Same with 401k, pension, etc. And then finally, Mark Cuban, he's been very active on Twitter, weighing in on these developments. He wrote, "The tragedy of SVB is that it's not the wealthy taking the hit. It's the thousands of companies who borrowed from SVB and were required to keep their cash in SVB. Those entrepreneurs and their employees and vendors are feeling the pain, and they are who the Fed should protect." Of course, we do know that these depositors will be made whole. So one encouraging development from the weekend, but we'll see how this could affect future government decisions along with the Fed's interest rate decision that we will get next week.
And Ali, it does raise this issue. We talked about moral hazard earlier in the show, this idea that some of these, banks or some of these depositors specifically are getting backstopped, whereas perhaps other businesses that perhaps failed during the pandemic didn't get the same sort of treatment. This issue of fairness, is that being talked about a lot online?
I'm not seeing too much of that online as of now. I think people are still trying to digest what this means going forward. Of course, people are debating whether this was a bailout, whether this was something that the government should have done sooner. We will see what more can come out of this. But right now on Twitter, I think people are just trying to understand, how did this happen? And ultimately, how can we prevent this from happening again? So again, the sentiment is not very good right now. I think looking ahead to the future, there are going to be a lot of questions that the Fed, that the government has to answer to ensure that this is something that doesn't develop into a larger problem, that there's no more contagion. So we'll be monitoring this very closely moving forward.
And we did get the sense from President Biden that they're going to continue to look into this. Yahoo Finance's Ali Canal, thank you so much. All right, coming up, Congressman John Garamendi joins us to share his reaction to the recent bank collapses. Stay with us. Washington is demanding answers as the country reels from SVB and Signature Bank's collapses. Joining me now to discuss the latest is Congressman John Garamendi, who represents California's 8th District. Thank you for joining me this morning, Congressman. So I understand that you were briefed by the Treasury and the FDIC. Talk about those conversations and really the urgency in getting these backstops in place.
Well, the initial briefings we had beginning Saturday and into Sunday were essentially that the federal government, the Federal Reserve, the FDIC, and the Treasury were all working on a solution. At that time, we're looking at maybe someone buying the bank. Turned out that they were working on a much different solution. And I must tell you, I am so pleased with the president, not dithering, not taking a lot of time, but acting very aggressively to put in place a very solid financial backing for the bank at a time when the bank was actually investing in good, solid securities that were driven down as a result of the rapid rise in interest rates by the Federal Reserve.
But in terms of perhaps longer term, what sort of policies should be put in place to perhaps either improve stress tests or give a bit more clarity so that if we can, try and avoid a repeat of this happening?
Well, first of all, the Dodd-Frank legislation actually covered small and medium as well as the very large banks. In 2017-18, the Trump administration and the Republicans removed the medium and small banks from that same regulatory regime. And so they were left out there with some regulation, but not the same kind that the Dodd-Frank and the very large banks had to deal with. That may be part of the problem. But I think a much bigger piece of the problem was the fact that this particular bank appears to have most of its assets in government bonds, U.S. Treasury bonds. Those, unfortunately, for the bank, had a very low interest rate. As the interest rate was pushed up over and over and over again by the Federal Reserve, the value of those particular, that is the nominal immediate value, was significantly reduced. Now, if they were held to maturity, they'd be worth whatever the face value was. But that wasn't the case. As the run started, they had to sell those assets at a deep discount. The result was a failure of the bank. So there are several failures here that need to be taken into account. The regulatory regime had been removed. That may have made a difference if we had gone back, and we should revisit this and put back in place a regulatory regime for small and large banks, because contagion can start anywhere. And secondly, we need the Federal Reserve needs to be very, very much aware of what it is doing. Right now, the chairman is basically looking to eliminate 2 million jobs, that is, create unemployment to drive down inflation. Well, simultaneously, what he managed to do with that rapid increase in interest rates was to put banks in jeopardy.
But to that point, then, a lot of people online calling this a bailout. Is this essentially a bailout, if not of the banks, of some of these VCs who poured their money and perhaps didn't do their due diligence in terms of risk assessment when you do have such interest rate sensitive industries?
Well, first of all, there's two different pieces to this. One is the bank itself, its equity, its shareholders, and management. They stand to lose everything, as they should. That's the equity in the bank. And, this has gone into bankruptcy. Therefore, the shares are worth zero, maybe nothing. And of course, the management will lose their jobs, as they should. Now, that's where the jeopardy lies. That's where the risk is. With regard to the depositors, how are they to know on a day-to-day basis, even though they may be very large and may have a great deal of money invested in it, how are they to know the underlying financial status of that bank? Well, that's where the regulators come in. And apparently, given the very rapid increase in the interest rates and the similar rapid decline in the daily value, that is not the face value, but the nominal value of the U.S. government bonds, then we wind up with a bank that's in trouble. So what's happening here is the risk still remains to the shareholders of the bank and the management of the bank, and the depositors, those that have relied upon the bank being sound, they're going to be held whole and not be held into account. And I think that's a good solution. Much needs to be understood here that the president didn't dilly-dally, just as he did with the American Rescue Plan. Within 45 days after becoming president in 2001, the president and the Democratic Congress put together the American Rescue Plan, which basically stabilized the American economy, kept many, many businesses in business, provided for their employees to remain employed. All of that was put in place very, very quickly by President Biden. And here we are once again when we have a banking crisis, the president and his administration stepping forward very aggressively to put in place a solution to stabilize the situation and allow us to work our way through this problem.
Because some of the language that we were hearing about the catastrophe of what this would mean to have so many tech sectors affected by this. And then when you think of some of the things that President Biden was asking for, management being fired, more oversight. But when you do have a bank that is so focused on tech, is there going to be some sort of oversight and perhaps some sort of diversification that's required so that you don't have a bank that is essentially a version of too big to fail by having such a dominant impact on the economy?
Well, first of all, this is a regional bank, and you would expect a regional bank to be banking in this region. And that's exactly what the Silicon Valley Bank was doing. And most regional banks do that. Sometimes they step beyond their region, often to their significant risk because they don't know that region. But there are many, many different kinds of companies that were banking at Silicon Valley Bank, not just what you might call the high-tech companies. There were companies that were probably in the, the restaurant business and beyond. Well, we don't know all of that, but it is a regional bank and it should be banking in its region. That's where they know their business. Now, the big multinational banks, their region's the world. And they've made plenty of mistakes as they try to analyze the world economy and the world and the various businesses that operate in that worldwide situation. So I wouldn't say that it's a problem for Silicon Valley Bank or any other bank in the Bay Area to pay attention to the Bay Area, the San Francisco Bay Area businesses of all kinds. And so let's go forward here. You got a bank in New York that has also been taken into receivership. And it was undoubtedly banking in the Manhattan business community, as it should.
Indeed. So we'll be keeping an eye on this. I do thank you for taking time with us on Yahoo Finance this morning. Congressman Garamendi, thank you so much.
Thank you. Have a good day.
You too. All right, coming up, Pfizer is doubling down on its cancer treatment portfolio. We'll speak with the healthcare company's CEO next.
What's going on, everyone? Yahoo Finance here at South by Southwest in Austin, Texas. Check it out. We're getting the pulse of some of the biggest mega cap tech companies, the founders, the CEOs, and a lot of those text threads that they're having right now are still revolving around the Silicon Valley Bank collapse here. We spoke with a few of those tech CEOs. One of them told us that Monday is D-Day for a lot of companies, and within weeks, shops could be closing up, and within months, ripple effects could be felt across the rest of the economy. We're going to continue to keep an eye on this in our conversations, as well as what is to come next. The thought is that there might need to be a massive bailout, and it needs to come soon.
Welcome back. I'm Julie Hyman. Pfizer has agreed to pay $43 billion, including debt, for biotech company Seagen and its pioneering cancer treatments. With more on what this major merger means for his company, we're joined by Pfizer CEO Albert Bourla. Albert, it is a pleasure to talk to you here today. Congratulations on this deal, which, as I said, is a big one. And in reading some of the analyst coverage, they are talking about the fairly hefty premium that you're paying for Seagen. Presumably, you had to outbid some peers. There had been some reports of others being interested in the company. Why is it worth it for you guys to buy this company and at that price?
Let me start by what we're trying to achieve, right? Is to battle cancer. And cancer, it is one of the deadliest diseases in the world. Right now, 1 in 3 people are said to get cancer in the course of their lifetime. And ADCs, which is the technology that Seagen is mastering, is considered one of the best ways to be able to battle cancer. So in reality, what we try to do, it is to be able to make a meaningful difference in the health of people, as we did with COVID, but now in another extremely dangerous disease, which is cancer. And we looked into multiple opportunities that would allow us to do such. And Seagen stands out for the tremendous complementarity together with our own capabilities. By putting 1 + 1, we do not expect to have 2, we're expecting to have 3 or 4. And that's very good news for cancer patients.
And as you say, this ADC, antibody drug conjugates, which is supposed to be a more targeted way of attacking the cancer, this is sort of a bet on that technology. You know, you and I have talked throughout the pandemic, and now as we enter a new phase, and you really made a name for yourself at Pfizer in terms of vaccines, getting the speed to market, the way that you attacked that issue. I wonder when we're at the tipping point for cancer in that regard, because obviously this is something that folks have been working on for a long time. Do you feel like we're getting closer to more meaningful ways to fight it?
I think we are, and since today we are even closer, because exactly what was missing was the match between a company with our own capabilities, our ability to develop clinical development at scale, at the speed that you just spoke, the ability to manufacture at quality and high speed, our ability to put financial and scientific resources in the hands of a group of people that have done some miracles with the technology that they used in cancer, which is the Seagen people, I think will deliver results equal to the results that we were able to see in COVID.
When you talk about the sales you guys expect from Seagen, $10 billion is the target by 2030. Last year, you had about 12% or so of your sales contributed from cancer treatments. You know, you've got the COVID medications and treatments and vaccine that are declining in sales now. You've got some other things that are rolling off that you have patent protection on. How much of a percentage, how important is cancer going to be as a franchise to Pfizer going forward?
Look, cancer before COVID was way higher as a percentage, so it was a very big part of our non-COVID business. But still, it was not among. We were not among the biggest oncology companies, right? I think the combination with Seagen will make us way more competitive in the space. And it's not the size of Seagen as it is coming right now, which is already $2+ billion of current sales, but it is, as you said, the growth potential that they have, because those sales are coming from 4 products that have just been introduced, and there is 15 new pipeline products that are coming. So we'll exceed $10 billion. With $10 billion in year 2030, we'll be a significant player.
Albert, the administration has been relatively aggressive with the Department of Justice, the FTC, in scrutinizing deals. What's your level of confidence that you're going to get approval for this one?
It is very high. I don't think you can find a cleaner deal. There's no overlap. Okay, that's a short and sweet answer. Given the events of today, I want to turn to Silicon Valley Bank and kind of the fallout, the broader fallout. We've heard some folks talk about what this is going to mean for biotech startups, for valuations there, et cetera. I know you're just announcing a big deal today, but I do wonder if you're casting your eyes to some of these biotech startups and you see some opportunities as a result of the fallout. Right now, what is my concern when it comes to Silicon Valley Bank? It is what could be the impact on these startups, because we are all part of a broader ecosystem. It's not how we can get our hands around them and steal the companies now that they are in dear need. Not at all. It's not how we operate. And I don't think many of these companies that will face financial distress are really acquisition targets right now. They need to progress their job. But I'm wondering how to make sure to ensure that they won't disappear. A lot of startups that can become eventually companies like Citizen one day. It's very, very important for our ecosystem. And I'm monitoring the situation and the announcements to see where this goes. So what would be the way to support them potentially on the part of the industry? Would it be, starting some sort of fund to invest in some of these companies, for example? That could be one of the options, but I think right now we are looking to see if the government will do something, which is quite, I think, important. But beyond that, if nothing else happens, we should see what could be our options to be able to help them. There's one other question. It's going to be very bad for science, if a bunch of startups, for no reason, just disappear. Startups that could provide the Alzheimer's medicine, the cancer medicine of the future. Certainly, that makes sense. There's one more quick question I have about the fallout, though, which has to do with the credit markets, because you are planning to finance this deal, at least in part, by selling debt. Any concerns about that kind of a sale in this environment, given what we're seeing unfold? No, we calculated that will not be very cheap. Like it is now higher interest rate. So we know that will be a blended interest rates around 5%. And, it's not pleasant to have to pay these interest rates, but it is way within our ability to raise debt. Albert, good to see you. Thanks so much for joining me today. I really appreciate it. Albert Bourla is the CEO of Pfizer, talking about the acquisition of Seagen. Appreciate it. Thank you very much. And coming up, we've got much more to come with our coverage of the fallout from Silicon Valley Bank. We'll tell you what to expect next.
We definitely had a shake-up in how people think about risk, and we're going back to good old basics. The T-bills is probably pretty safe relative to bank deposits, and that's a lesson a lot of people have learned over the last few days.
But they seem like they should have been obvious at the time. Really, really fast growth, which is what Silicon Valley Bank had, is a red flag at a bank. It's a sign for somebody to take a closer look. And so what worries me here is that this does seem to me to be an overarching failure of the Fed, both as a regulator.
I think fundraising, from what I'm hearing, is definitely going to be slowing down as people evaluate their next steps. And from founders I'm speaking to, the general advice is decentralize where you're keeping your capital.
So they're going to end up going to the biggest and most well-capitalized banks, which longer term is not a great thing for our banking system because we don't want to have, too much concentration.
Well, there you have it. That's a roundup of what we heard from our guests this morning on the collapse of Silicon Valley Bank. Now, coming up in the 3 to 5 hour, join Shauna Smith and Dave Briggs as they continue our coverage. They've got some big interviews on tap, including a conversation with California Representative Brad Sherman to get a pulse check on Congress. They'll also speak with the general partner at Delta Blockchain Fund about the state of crypto. And they'll have all of this and much more, so you don't want to miss it. Before we go, though, let's do a final check of the markets as we head into the noon hour. We see here all three in positive territory, though off their session highs. They were bouncing around when we started the show, but now heading down a little bit, losing some ground. The Dow there, though, still up 150 points. The S&P up about 20 points, 0.5%. The Nasdaq there up over 1% on the day as well. We're seeing banks still under pressure. So that's also why we're seeing our top trending ticker, First Republic Bank, taking a hit, even after getting liquidity from the FDIC and JP Morgan Bank. Well, that will do it for now. I'm Rochelle Akufo, but do stay with us on Yahoo Finance Live. I'll be back at 11 a.m. Eastern tomorrow. I'll see you then.